Hi everyone. Request everyone to please settle down if possible. We'll start in a few minutes. Welcome back, everyone. Let's get started. There are some seats in the front if people would like to have a seat. Folks who are standing at the back, we are going to live stream this in CR13 if people would like to move there and have a seat. Perfect. We'll start with the session for today. Welcome back. Hope everyone's refreshed after lunch. We'll get straight into the segment now. We are continuing with the format from our morning discussions, but with the thematic conversations that our alumni founders have shared reflecting on their journeys. Before diving back into that, let's use this post-lunch hour to discuss the startup investing climate in the country. As we've said before, the summit provides a unique opportunity for us to collectively engage with the potential of emerging startups. Understanding the sentiments of investors is key for both active and aspiring founders. The past couple of years have seen interesting chapters in startup funding, as most of us would be aware, filled with uncertainties, new lessons, coping strategies, and some breakthroughs as well. In our next discussion, our goal is to peel back the layers and uncover unfiltered observations and sentiment from investors. What makes this special is being a part of this exclusive community of IIMA alums. Today's forum gives us the freedom to have candid conversations free from filters and biases. So without further delay, let me introduce our panel set to unpack the inner workings of the Indian VC ecosystem. Geeta Goel, Country Director of the Michael and Susan Dell Foundation. Rahul Chaudhary, founder of Tribo Hotels and has now turned VC with Matrix Partners. Siddharth Nautiyal, partner at Omidyar Network. Kitty Agarwal, partner at InfoEdge Ventures. And VT Bharadwaj, general partner at A91 Ventures. Guiding this discussion, we have Vinod Murli, co-founder and managing partner of Ulterior Capital. A warm welcome to all of you to please join us. Just a quick reminder that we've allocated the last 15 minutes of this session for audience Q&A. So over to you, Vinod.
Thank you. Thanks for that. So good to see a big crowd here just after lunch. So first disclaimer is we didn't know this was being televised. So we had a lot of interesting questions planned, which we have to tone down now. But let's just do a quick straw poll. How many in the audience think this year will see more capital than last year? Very optimistic room. So just to give a little bit of guidance on what we are planning to do today, we have a very diverse set of folks here. Growth investing, venture investing, balance sheet, off-balance sheet impact, and moving from strategy to balance sheet to fund, right? So, and entrepreneur to investor to entrepreneur. Hope that's official now. It is now. So we wanted to get some of these perspectives in to address some aspects of the investor's mindset, their everyday life. And oftentimes it looks, and for sure it is, the founder's life is extremely hard. There's a lot of friction, a lot of challenges. But maybe the investor's life is not too different. So let's get going. I'm going to start with a topic starting with VT. So let's talk about a situation where you've had a very different view compared to what a founder, in terms of strategy, company strategy, what the founder wants to do. So a couple of scenarios. One is your view was right, and one where your view was wrong. Where you had a counter view, and how did that play out between you and the founder?
Oh, straight away diving into...
Straight away. There's no slower ones. We start with the bouncer.
Yeah, I think two examples I can think of both. First is a founder in the beverages space. We were early investors in that company, and I think the real question in that company in terms of ability to scale was what is the price point at which you need to operate. And this founder had come up with an interesting product. It was what I would argue was a premium priced beverage. Think of a 20 rupee, 30 rupee price point. And one of my worries always with consumer founders in India is you start with a product that you like, and we forget that we are 1% of India, right? And therefore, the way you have to think about really expanding the market is going down. And what you think is going down is maybe going up or aspirational for others. And sometimes that's a big conflict and a big cornerstone. So I think in this case, my point of view was that if you did not go down from 20 to 10, your market size will not be 1/2, but 1/10, because that's how rapidly incomes fall in India. And this is a big debate, but I think finally reality of the market hit, and for the company to really grow and build the business, they had to go down. So this is an example where I was right. But of course, the founder had to discover this. So I think one of the things you will realize as an investor is you can offer all your views in life, and you can give your point of view. But finally, it is the founder's call on when that information is going to be processed and what the reaction is going to be, because it is the founder's company. How much ever, irrespective of shareholding, right? That is the reality. I do think that here it took time. Maybe it was 18 months late in terms of kind of moving around and figuring it out. That's an example of where it worked, where we were right in terms of how we were thinking about the market. Well, another example, interestingly, is a premium apparel brand we are recent investors in. It's a more premium than what is available in the mass market, and the founder had built a business digital first, selling online, and he wanted to really build a general trade business, which is find a way to sell in small mom and pop. And my point of view is that it'll be impossible. And I said, look, at this price point, I felt it'll only be online. Maybe you can build exclusive stores, but you won't be able to build a business where you sell to mom and pop. And I think, and the founder started and then realized that general trade did not work, but which is fine, which is anyway our hypothesis. But I think what he was able to do is innovate and come up with a slightly different format for hitting general trade. which is truly remarkable. I don't think he's truly probably the first of his kind in that category to do what he's trying to do at the store level. Almost think of it as like, a beauty store type approach for a apparel product, which has not been tried before and seems to be having a lot of success with it. So an example where I would say we were completely wrong. I think we thought that it'll be impossible to build, and looks like that may very well be the most attractive business the founder will build.
So your first example, I thought you were pressing a raw point till you actually said the price dropped.
Yeah.
So it's not that.
It is not raw. It is paperboard. Actually,
Yeah. So it coming to you, let's see a different dimension of the same question, where it's not a dissonance with the founder, but us that are there along with you in that deal. Now we'll actually go around on this part where different investors can have different timetables, their schedules, orientation in terms of what they expect out of the investment. So have there been situations where you've been like absolutely sure this is the right thing to do, but you didn't have support from the rest of the board? What did you do, or what didn't you do?
Well, that happens more often than you might be aware of, right? So I'll give you an example of something which happened and then got resolved in a satisfactory way, just a happier story that way. So we had a situation where unexpectedly we had a pretty interesting M&A offer for a company that we invested in, and that zoomed. And it zoomed so fast, and there was so much interest in the company from other investors that folks thought on the board. Now, I'm not saying who said what, okay? So there were multiple directors on the board. One director thought, well, this is going so well, let's put in more money, we'll make even more from where we are right now. Some other investors were swayed by the founder's views that I think this is a great time. We should try to make sure we exit, because who knows what the future holds. And I remember a discussion on the board where one board member is telling the other board member, are you really going to run this company? If the founder believes that there is more value to be selling right now, would you rather be running this, or would you rather be going with the founder's gut? As it turned out, and this is I think what VT mentioned earlier, we might do a bunch of things, but really the reason we're investors is because we're not founders. We're not running the company, we're backing the founders. If the founder tells us that things are a particular way, they have way more skin in the game than us as investors do. If they think this is the upside they want to capture, I think it's judgment. I mean, at some level, we also have to make sure that investors, we stand by our fiduciary responsibilities and make sure the founders are doing the right thing. But more often than not, the founder's view is the view that prevails. And thankfully, in this case, judgment prevailed, and then there was alignment, and we were able to get that interesting M&A that in hindsight, from a financial point of view, made us all look extremely
It's a
smart.
very black and white story that you're talking about there. But I have my own misgivings on that, because we were about to give debt to that company, which didn't happen because they got bought. But Geeta, coming to you on the same question, where the way you're looking at your investments, we spoke about Ujjivan going back several years, where the legal bill, I think you said, was more than the investment amount, right? And it's come a long way since then. So how do you look at stakeholder management at the board? And we have a couple of companies in common as well, where your objectives could be significantly different from others on the board.
In many ways, I feel our objective should not be significantly different, because otherwise. Okay. So in many ways, I feel our objective should not be significantly different from any other mainstream investors or founders, because if we are doing that, then we are, sort of pushing the company at cross purposes. We are an impact investor. We are actually a balance sheet investor. We are also a philanthropic foundation. So, we play many roles in that. But when we invest in social enterprises, the idea is we are taking some early risks. We are trying to catalyze a market shift. And then we do want the company to follow the same financial discipline, which it would if a mainstream investor were to come in, because that's how the company will scale up. So taking the example of Ujjivan, when we invested in them, the idea was we wanted to push urban microfinance or catalyze urban microfinance. Many investors thought it was high risk and therefore were not investing. I think Samit had just set up one branch. There were like 50 customers when we came in. So we took the early risk, but again, the idea was that at the core, the company should focus on urban microfinance customers. We didn't want them to go rural. And thankfully, the urban market picked up. And so we had a good sway. But as other investors came in, as long as the target segment focus remained the same, I would say our interests are aligned with everybody else, because we want the market to grow. We want more capital to come in. That's how it will scale. Yes, you could argue that mainstream investors may have wanted higher interest rates. We may have wanted lower interest rates. But at the end of the day, the company has to sustain in a market. If a certain interest rate is what gives it sustainability and the push and the margins, I mean, that's how it will grow. So I feel there are limited instances, Vinod, where we come in conflict with other investors. Timelines, yes. Growth trajectories, yes. There are conflicts because sometimes we may prioritize sustainability over growth or whatever. I mean, just given the balance sheet that we come from. But I feel unless there's a positive correlation between impact and returns, the company will always struggle to make both meet. So I'm trying to see, I think the Dehat founder was here and he was like, I'm commercial, I'm social. I mean, at the end of the day, it's an enterprise which is serving a certain target segment. If you're delivering something positive, it is a social enterprise and then it should meet its commercial returns. But yes, because it was our first investment, we spent more on our legal costs than the actual investment we put in the company. But hopefully the tables have turned now. We don't do that.
Paid off very well. But just to pull that thread a little bit, you talked about the fact that like even Dehat and a few other companies, there is a little bit of an identity question or positioning question on is it for social impact or for commercial impact or for both? Now, if it's both and both doing well, it's an easy answer. If only one is doing well, which one matters more?
It depends on the founder, really. I mean, so for us as an investor, we are impact first. But if, for instance, let's just take the case of Ujjivan, and we said urban microfinance does not work. And in order to make sustainability happen, Ujjivan had to shift to rural areas, which was an easier market. I mean, we may have said yes, we may have stopped further investing, but at least the company would have continued. But having a company that is loss-making, that has no future and serves our target segment doesn't help. So yes, I mean, somewhere we have to make those calls.
Nicely played. Kitty, you said I can't take certain names, so I won't take those names. But let's talk about timelines, right? In terms of you've done balance sheet, you're now in a fund. So especially as companies go towards growth, listing, decisions around liquidity, and you have more staying power than your other investors. Have there been any such, say, conflicting situations and you've had to take a strong position either ways? Any comments on that?
Yeah, I think it's very different, balance sheet versus fund investing for sure. At the fund, we are long-term investors because our fund is also 10+2, but I would say as the team running the fund, we are still very mindful that we need to return this money and we have to be answerable to our LPs if there are delays or if we manage to make decisions which end up in loss of returns. So there have been, while we were investing from the balance sheet, of course, a few things. One, when should a company IPO and at what price they should IPO has always been a very big point of discussion, because as InfoEdge from the balance sheet, if we are long-term investors, we are okay if the share price goes up post-IPO and the next 5 years are great and we believe it will reflect in the market value, whereas someone who wants to take a secondary exit at the IPO, another investor might want to really push the price up at the IPO and sell a good chunk of their shareholding. So in those cases, I think we've generally had a bit of conflict on the timelines, on the price, etc. So that has been one. But having said that, I would say at the fund today, we are also very mindful of those things, and at times we fall prey to saying that, okay, for 2 years, if you're not going to grow and you're just going to focus on profitability, we all want that, we want you to survive, but then at the back of your head, you're always really stressed. In terms of you having gone in at a valuation which probably can't be justified, but on the balance sheet, you were okay with it. You would tell the founder that take 2 years, take 3 years, don't worry about it. So I think these situations change.
Rahul, founder to investor, First question, why? Why did you become an investor? And second is the same conversation around dissonance with an investor. Has your perspective changed? Because you handled it from the other side as a founder, and then you had to give maybe some hard feedback to your portfolio over the last year and a bit. So one is, why do you want to become an investor in the first place? One A is, why did you choose against it now? And two is, how do you see it from a founder's perspective?
I think that decision to try investing, at least, and I was fortunate that Matrix team had a role, and I was able to experiment with in this phase, was simply I wasn't fully feeling committed to the idea of starting again at that point in time. And I think before your company needs runway, you need emotional runway, and I don't think I'd banked enough, and therefore thought that was the right time to try something else. I felt there was a noble purpose associated, as well as more operators turn into investors. There's an alternate perspective, hopefully, that some of us can bring to the table. So that was the thinking. I think I've greater appreciation now. Obviously, spent a year or so on this side on how not easy the investor life can be. I think I dissed the profession for far too long. I think it's a hard profession in the sense you don't have too much control. At least I've felt so. As a founder, while a lot of things are going wrong, you always felt a certain sense of orientation, a certain effort to reward linkage. I could stop the company in the middle of the month and say, guys, spends down. What are we doing? Is this adding up towards our goals for this quarter? I don't think I could do that in an investing role. So it was a little bit harder, and I have appreciation for how difficult your lives also could be. I think in the tough situations, this comes out more acutely, and people say crisis doesn't build your character, it only reveals it, right? So I have had like any other company that's been around for a decade, Trebo has had its own share of ups and downs and sideways, latest of which was COVID, which is obviously the most extreme case for a travel company where our revenue went down 97%. Deep was talking in the morning about it plummeting 96%. We went down to 97%, almost didn't exist. So we've had our own crisis along the way. And I think that's when different investors tend to, investor isn't a single, it's not a single cohort, right? Everybody behaves differently. So you see different viewpoints around the table. In my experience, the ones that at least founders tend to benefit most from are the ones that have had some kind of ken. So, knowledge, empathy, and network. And a lot of the investors are able to bring knowledge and network to the game. I think a fewer number are able to bring empathy and true empathy. Amongst, we are fortunate to have a good board, but amongst the people who've added most value, I think there are people who are willing to disagree and commit. So even though they may have a different point of view, they had enough empathy to look into our own personal journeys and say, this is the person that's closest to the crisis. As an example, we got a offer for investment at terms we didn't like from a strategic. Now this was very early in the company's journey, and my gut call was, no, we shouldn't do this now. And everybody else may have, on a certain spectrum may have felt differently. I think the best investors left it to the founders after giving all of the blind spots that we may have had, and we took the decision to not go in, but did it 5 years later. So we've got to, I think VT, you mentioned, people have to find their own comfort in the decisions they take, because founders run the companies and investors are good supporters.
Fantastic. I think I was looking to go to that topic a little later, but let's pull the thread on empathy and fiduciary responsibility, right? So let's jump to Sid. Needs a mic. So the question here is, even the case that Rahul talked about, in fact, I think I know which time he's talking about. You're empathetic, founders going through difficulty or a difficult problem to solve. If you know very well that what the founder's doing is some level going to hurt, I'm not saying that's the case that happened, if it's going to hurt the company or not. You have your own responsibility as an investor. Where do you draw the line? You know, you're a human being, you're emotional. He said Ken, so there's 1/3 of that you have to demonstrate. So where do you draw the line? Because you have your own responsibility to your stakeholders, your LPs. Thoughts on that?
Yeah, I mean, finally, the money that we're managing is towards a particular purpose. For us, the idea was to be able to create impact with the money and also generate financial returns from the money. And we chose the company and we worked with the founder because we felt those interests were best aligned. And the working with the individual, with the organization could help us get there. See, when something happens that I might not agree with, I might have a strong point of view on that this is wrong, the company shouldn't be doing it. Like every individual, we always have a choice, right? I could always insist and try to build a coalition saying this founder is actually taking the company the wrong way. Let's make sure we replace this founder. And in certain cases, that has happened. But that is rare. I think more often what will happen is that you will provide your thoughts to the founder. And a mature founder will appreciate that where you're coming from is from a place which has the best interest of that company in mind. Because only when the organization succeeds will you as an investor get returns for yourself and your investors, and will the impact that we care about happen as well. And if in the founder's judgment, so long as the founder has my trust, the best thing is to be acting in a way that's different from my advice, so be it. I think we have to make sure that we give the founder the chance to do what he or she wants to do and then prove it. If it reaches a stage when there is no trust, where things aren't working out, and separations do happen. It's rare. And when it happens, it's even more rare that companies recover from those separations, because it's a body blow to an early stage company to have a founder who's closely linked to the organization moving on. You try to avoid that, but you try to avoid that not from a place of fear. You avoid that because that's not in the best interest of the organization. And so long as things are uncomfortable, but you know that there is best effort happening from the other side, I would always give the benefit of doubt to what the founder's doing, because they're doing it with a lot more interest and a lot more self-interest than I could do.
Skin in the game.
Skin in the game, yes.
VD, different thoughts, same thoughts?
No, I was just going to add that same thoughts. The only thing to add is, we've had a situation as well where if the trust is broken, you can also go to a situation where you tell the founder that, hey, this is now a failed marriage, and therefore let's have an amicable divorce, and therefore in the next round just get me out. And I may be leaving some upside on the table, but just don't care. And that has also worked for us, where we've got into a situation where we said, hey, if this is how you want to run the company and your other investors are okay with it, if we're not okay with it, let's just move on. And I think
Does that put a burden on the founder to find an exit?
Yeah, of course, it's not like it happens immediately, but I think in this particular situation, it worked out well, where the founder could, there was another investor who was excited, and you said that's fine. And you may be leaving some upside on the table, but at that time you're not negotiating for the commercials, right? You're just saying, hey, this relationship is no longer working. So what is the quickest way to minimize the damage? But otherwise, the sequence is exactly like what Naughty said.
Different question back to you, which is on valuation mismatches, right? We saw 21, 14, 15 rushes and the kind of liquidity surge that happened. So if you think about decisioning in those times versus today, and not just decisioning, process, diligence, time frames, who goes to whose office, do you call them over, do you camp in their office, and everything is supply demand in some sense. So, and you've seen cycles, right? So what are the obvious differences and what are the subtle differences between bull market investing and investing today? It's an optimistic room, but we're nowhere close to high.
I think the tactical stuff, and then I'm talking about the strategic stuff. I think the tactical stuff is in a market like this, everyone seems to have a lot of time. Investors, lawyers, auditors, diligence partners, everyone. So sometimes it's insane as to how long things can take, to close, as they say.
It comes with the founder's expense.
Nah, no, I think honestly at everybody's expense sometimes. Sometimes, people just, because you just have so much time, it feels like everyone can take a lot of time, and that not necessarily adding to the value of the decision, right? I think the other material difference, I would say, during markets like this versus markets like 2021 is, I think the person who is making a decision today to invest is truly making a decision to invest. We don't know whether it's right or wrong, but the conviction is real. Because the environment or mahal is like, you're not punished for saying no, right? Versus in 21, there is, I think, massive adverse selection. I think as a founder, you may be getting an investor who's really not investing because he's understood the business, but is investing because it is hot, it is exciting, his friend is saying it's a great investor. And one of the things founders, I don't know whether you're aware, is that the investing community in India is this thin. There's some 150 people who are like having coffees with each other. It's literally that thin, right? So it is scary how much of the conviction can be so easily borrowed. So what you don't know as a founder, I'm taking a founder view in 21 or in 14, is you don't know whether this person is coming on the cap table is really understood why they're coming on the cap table. Which is a risk because it reveals itself only when life is tough. It doesn't reveal itself when things are going. I think that's one big difference. I think the second big difference is one of the things, in the community things is that, when investors come in at a high valuation or a valuation which is looking not so straightforward from the business perspective, they think the burden is actually on the investor. The real burden of a high valuation is always faced by the founder and the company. For an investor, remember, finally at the end of the day, it's a portfolio. And there is a portfolio in terms of time and portfolio in terms of company. The real burden of raising money at excessive prices is always borne by the company because there are two consequences. One, when you really need more capital, you're struggling because, in India, especially in India, you have this notion of down round and up round, and versus saying, hey, this is the market, this is the clearing price, should I raise money? Which is what you would do as a public market company, but people in private companies struggle with that psychologically even today. People delay. Companies that should be raising money on time, delay fundraising. They're optimizing for existing investors on the cap table because people have come in at different prices. The worst is investors who have come in at the highest price don't want you to raise any more money. And by the way, they also don't have more capital to give you, right? So
Guess which product helps them then?
Yeah. Yeah, you give venture debt and then you push out the problem by 9 months, but the problem still shows up, right? After 9-12 months. So I think that is the other challenge of a bull market, which is when you raise money at high prices, the burden is sitting on you. And the other problem with the bull market raising money is you've raised money so easily, you've forgotten how hard it gets, right? Convincing, persuading people to part with their capital has to be difficult. Because that's when the capital that comes to you is thoughtful, efficient, etc. So I think there are lots of differences, but I would say psychologically at least these are the two big differences. So today when we go and we are investing, we had one of our busiest years last year, and we hope this year will be even more busy. Is you are really getting to meet founders who I know are raising capital at a tough time, but they're raising it from a reasonable position of strength because they know they are running a good company and they know they need this amount of capital for a real purpose. And they also know that every person who's talking to them is because their person is seriously interested and is trying to build real conviction of the business. I think that's the advantage. Now, sure, the valuation may not be the highest. But then what that is forcing them to do is to really ask how much capital do I need? And therefore, do I want to dilute so much or do I want to dilute lesser? So every right question, right? How much capital? Is this person really committed? Those questions are easier to answer in an environment like
Yeah,
this.
so Geeta going for it. So I'm going to come to you, but just one quick point on that is, as long as the founder has 2 term sheets, I think there's enough FOMO created to create competition. And today that's happening for sure for the high quality companies. So it's not like there's a dearth of capital. I think for good quality companies, there's still a fair bit of fight going on to get the right price. But
Actually,
love to hear
I
your
also
thoughts.
wanted to come to the FOMO, but I had one comment to VT's point. I think in the course of my investing journey, I came across 2 founders. One who actually had a higher price on the table, like let's say 500 rupees a share. He came back to the existing investor saying, I'll take it at 400 rupees because I don't want to create the pressure of growth on me. So, that...
Introduce
and
us
our
all
own-
to them.
I mean, my own respect for the founder really went up because of that. Another founder who was getting like 4 investors on the cap table and taking double the money versus saying I'll just take it from 2 and I want lesser investors, because these are all in their first 5 years of existence. So you want, more camaraderie or whatever in the investor base. But I also, I mean, not
Just on that, was there a correlation to eventual success on the paths?
Yes, it was on both sides. I mean, I just think the boardroom discussions, I mean, they just changed, and the founder also took a lot more control. I mean, in both the cases, they, showed their own strength of whatever conviction. But I did have one question, maybe for everybody, but coming from VT's point on, things just take long. I mean, it's not because people have time, or maybe it is that, but I mean, why do we not have more standardized templates, more transparency in the VC market? Like, it almost is like the law firms are making money. It takes like 6 months, 9 months to close a deal. You get what you can, versus when I see like my counterparts in the US, like they seem much more standardized. So I don't know if this is the 150 member VC mafia, which is getting us there, but I mean, it does come at a significant cost to the founders.
No, I agree with you. I also am constantly befuddled. And sometimes it feels like people are just resetting what their expectations from terms are depending upon the nature of the market. The craziest one is the most recent investment we closed. We could have maybe closed it 2 months shorter. But one of the investors said, I will not give you title indemnity for more than 5 years. So there are crazy stuff which frankly should never be renegotiated, but do get in a market like this, and then you're left wondering. So I agree with you, it's self-inflicted, but I do think the fact that diligence partners and lawyers have more time means they do spend more time. They do have more time.
I think it also depends on the instruction that goes from the investors. That's frankly my view on that. And many companies often face the brunt of it because they're running on fumes by the time they get to close an investment. And we do see a lot of term sheets get reopened towards the end. And some deals do fall off. So it's all of the above. So it's, in some cases, it looks like a very obvious negotiating tactic. And there are some investors, but the thing that investors forget is memories run long. People remember who's reopened term sheets or reneged on term sheets. They will do deals now, but it'll be difficult for them to get the same kind of outcomes when there's a little bit more liquidity. So it's a constant risk that is being run as well. Having said that, there have been actual situations where companies have changed in terms of what they promised and what they delivered. So then that looking at the data again is not unwarranted. But average deal times, which used to be about 3 to 4 months, is now 8 to 9 months easily.
Don't you think it's a little bit to do with the maturity of the two markets? I don't know if there's another market at the stage of India. I haven't looked at the LATAM market, and if it behaves similarly. There are two issues with the vintage, right? One is there are newer founders coming in who've got no experience with this. There are newer funds being set up every quarter. Those guys need to win that deal. They don't have necessarily the brand name or the capital associated. So they may want to fight with terms, slightly more lenient versus. So there's a plethora of options available. Number two, you haven't seen the cycle enough as an investor to know this term is not going to matter at the end. This is not why you will not make the money. There may be many other reasons. So my sense is as that, I don't know if between your first investment in Ujjivan versus now, if that's changed and all, I don't think we need standardized terms. I think we need standardized rates for the diligence partners, and then everything else will work out.
Not on hourly basis.
I can agree, and for every budding investor, if there's one piece of wisdom I can give after 15 years investing is, nobody has ever made money on terms. The only time you make money is if the company does well. If the company does badly, nobody makes money. Despite that, there is a reasonable amount of legal fees being charged to the industry every year.
I also, lest it should come across, as an investor self-serving panel saying on the valuations, you should price it right. I've been a founder. I probably will be a founder again. And I can tell you that I've lived that experience. To raise at a very, I'm going back to the previous, to raise money at an exorbitant valuation is the one thing that'll keep you sleepless. I think your company deserves 100% of your attention. The last thing you need to be worrying about is whether you've been able to step into the valuation that you've raised at. If I were to go back, I would just never do that again. And so making a difference between two term sheets that may be high price versus low price, I would just take that out of the equation as long as it's a reasonable price. I would focus a lot more on the person you're going to get into partnership with. I think that's really understated. I think we are at a place where personal brands on the venture capital side are starting to get built. But my sense is in 5 years, people care more about who they're taking money from as opposed to only the terms, or that's what I would hope.
I agree. I think it's also the maturity of the ecosystem where now there's a personal brand that is visible and people know, okay, I want this partner on the deal, or even other folks in the team. I think that, especially for sectoral expertise, that's definitely coming through. But let's switch gears a bit and look at anti-portfolios, right? So question to everybody is, a deal that you really, really wanted to do, but you couldn't. Either because your partnership brought down or you just couldn't. And guess what? The company went on to do extremely well. So who's going first?
Happy to go first. We keep a running list. Straight off the table, last 5 years, I would say Mamaearth. Clearly a company that we should have been all over and invested, especially in the consumer space. Big miss.
I think we missed investing in a clean energy company called Loham, which you are an investor in. I think it probably shaped the way the industry develops in India, and we couldn't get a hang of manufacturing. We were too close to our idea of services and online-driven businesses. It was too much of a shift for us to make.
So I don't have a public com, but we missed investing in Stanza Living because we were looking at them when we were still investing from the balance sheet, and there was doubt about conflict at 99 acres, whether it had a strategic fit or not. We ruled that it was not strategic, but by then they closed their round.
Let me know if you're still interested.
You can also say,
Ours, I think my worst one was Flipkart, 2011, venture debt. The warrants would have been enough to pay off a couple of generations.
I haven't been around long enough, so I don't have one.
Yeah, I have very different. For instance, in the microfinance space, when Equitas came in, we said this is the end of our investing because as a philanthropy, we don't need to invest in a company that is getting chased by investors. So I don't know whether it's anti-portfolio. Now I'm on the board of Equitas in a very different capacity, but it was a good company, and I think they've done well. And I think from so not a anti-portfolio, but I do feel like we've missed out as a foundation on the whole UPI and the NPCI journey. I think those were path breaking from a fintech perspective, but yeah.
Correct. So Rahul, let me come back to you with a different question then. Let's talk a little bit about the evolution, if any, of the venture capital industry, right? An allied point is, again, you've seen all the hard work being done by founders. Should 220 sustain? That's 2% of fees with 20% as carry. What do you think?
I think I have to answer this from the founder's standpoint because I don't have vintage in the VC world. Yes, please. My sense is just like any other industry, there is a price for every product. You can peg at a certain price. There's even 2.5 30. There is a 220. There is 1.5 15, and all of that. I think we are 17, 20 years maybe into this, right? Yeah. I think there are enough markers out there for hopefully people to make more informed calls on what fund managers they can, repose their faith in. If you're, 3xing or even 4xing a large fund, I guess there is a price somebody is willing to pay for that. But most people just haven't had the DPI. So I don't know if in that environment people can sustain that.
DPI, just for people, is the actual money that has been returned to investors on the money that's come in, right?
Yeah.
3-4x DPI in India.
Yeah, total fund returns. So, DPI, I guess people haven't even got to 1x in many cases. So, I think when that starts happening, it should. I guess it's sustained in the West, and that's a much more mature ecosystem. I wonder if that's doable. I think one challenge I face in India particularly is that cycles tend to be longer. At least it's taken me 3 years to understand my own business, then next 3 or 4 years to execute, then there was COVID, and then there is 2-3 years. I think what I struggle to often do is the short circuiting of time with money isn't, at least in many of the businesses in India, which are very physical in nature, just hasn't happened to the same extent as I would have theoretically, hoped when I started this in this ecosystem. And that does have implications, if not on 220, then at least on, some of the other things around fund structure, fund life, etc.
VT, before that, liquidity that has gone back to LPs, hence LP expectations, and hence 220.
No, excellent question. I think I'll just give some background to the audience because they may not realize, right? I think the whole venture capital and private industry in India exists because of America. So that's a starting point. I think up to maybe 98 or 99% of all capital in all private companies in India is largely American capital. And this is coming because the wonderful investors in America have a phenomenal risk appetite. They think about different geographies, different asset allocation. Some small percentage of the global wealth is saying, I want to take extra risk. And that extra risk is coming and saying, hey, I will allocate 1 to 2.5% of my portfolio in India in private, right? That's how the money comes in. And that's all the money in India. And even 15 years into the industry, that's what is supporting the industry. In that context, for it to be exciting for the person sitting in Midwest, who, by the way, may have more money invested in India than any other city in India, including Bombay. For it to be worthwhile, in this asset class has to generate at least 20% net IRR, right? On a sustainable basis, dollar IRR, which means, maybe 25% dollar IRR gross of fees and carry, which means 30% rupee IRR on a sustainable basis. Now, I think what we are beginning to see, now by nature of this product, it's a 12-year product, right? Which basically means in 20 years is when you will know whether it's working or not, right? And if it doesn't work, America will always gives a long rope, but then when they change their mind, they just leave, right? Which is how it is. That's why they're so successful. So which is what you will see. So the question is, will this ecosystem and community on a sustainable basis deliver 30% rupee IRR over long periods of time? And I think that's the bar and that's the benchmark. And that's not, by the way, the best. The American venture industry returns are phenomenal and staggering compared to this. So there's a real reason for them to say, why should I leave my Midwest and my US and come all the way, to an emerging market and trust money with a bunch of people whom I really don't know, right? I think that's the bar and that is the obligation. And I think therefore the question they're asking, and because they've been long-term practitioners in the industry, is actually not 2 and 20. I think what we don't know is venture capital firm survival rates are terrible. The number of funds, the number of firms which will raise a third fund, the fourth fund, the fifth fund, the numbers fall precipitously. And which I think as an industry, we have not seen that cycle. But in the next 10 years, for sure we will. Because that's the way the capitalism works there. They're not worried about 2 and 20 and 2.5 and 30. They're saying, you're not performing, 10 years into the business, you have fund 1, has it delivered, not delivered, thank you very much, I'm leaving. So mortality rate in the industry is actually much higher than people think. Today, sitting in India, it looks like, investors, cushy job, you sit there. What you don't realize is many investors, after 10 years, you really have nothing to do for the rest of your life. That is the risk for the investor and people entering the investing profession, and that's the risk for the business. And I think that is how the risk will play out. I don't think it will play out in fees, it will play out in survival rates.
Is there an instruction?
Sorry to interrupt the conversation, but if we can wrap up in a couple of minutes so we have some time for questions as well.
Okay, I thought we were halfway through. I think the thing I wanted to ask both of you was, you have 2 LPs, you have 1, right? So how does that play out?
For us, actually, it plays out really well because both the LPs...
Well answered.
But it does. I'm super happy. We do not spend much time in LP management. They're both very patient, long-term capital. It helps that both the LPs have had very long-term relationships, at least personally with me, a decade plus, each of them. So they're very relaxed. And I love the structure. I think anyone who gets to have like a very concentrated LP base, which has very deep pockets, high levels of trust, and of course, you do a lot of the things that you think are very important for them. So all the governance checks, at times you let go of certain transactions where you feel they might not be comfortable, and And that's okay. In the long term, you're trying to build a relationship with them. But overall, I would say it's just been a blessing, seriously.
Follow Kitty. Yes, it's good to have a single LP. I think but I mean the downside is the name gets associated, so the governance and the the pressure of the brand becomes even higher. And second is, if the LP makes up their mind that the Indian edtech market isn't going to perform, there is no counter. I mean, you can keep on sharing data, but so yes, I mean. All in all, I would say it's good because there's one person you need, or like one family you need to manage, and you're not raising money from 10 different investors. But I mean, the only downsides I would say are those two.
Yeah. So actually on the 220, I'd like to add something. I have a slightly different view. I mean, and it might be conflicting to what people want to hear, but I think investors are an unreasonably paid set of people. I have fundamentally never understood why people who go into investing are paid way higher salaries than those in operations. And what is that skill set which they bring or they build which merits them believing that they are so highly valued? I've been in the community for now 11 years plus. And so at our fund, even when we were having this conversation and they wanted to give us market rates, etc., we actually consciously made a call and we actually said we don't want people to get rich on salaries. If they want to, then this is not the place, because we don't think that's how this works. You need to get wealthy on carry, which is your profit sharing. So if you're going to perform, then it all gets made up. But fundamentally, I think 220, my belief is it's flawed, because the returns, I think, that are expected out of venture capital as an asset class, they have not been delivered historically, even in the short period of time that India has seen. I think it's a very, very high bar for anyone to cross. And I don't think all of us investors are bringing something so unique and amazing to the table that we deserve to have the 2%. I firmly believe that.
I think it's a valid point of view. And short answer is it's a short time frame. And hence the test is over a long time frame. I agree with VT on that, which is the first fund, you get your fees. Second fund, maybe, if you're around for your third fund or not, depends on performance. And you can skim off fees for one or maybe two vehicles. The LPs are a smart bunch, and they look at, and now the dispersion is showing in India. So 8 years ago, 4 years ago, it was very different. Today, I think you have 30 venture capital funds you can pick from, 15 growth funds, few venture debt funds. Performance is visible. So it's difficult to skim off on fees. Now, then it's a question of real performance, what is the real value, and beauty is in the eyes of the beholder, right? So if LPs want a particular fund, then they pay for that. But for the short term, agreed. And the last thing is the new fund manager, I would say there are frictional costs. So it's actually a curve, right? So your first fund, you want a little bit of generosity. It's a leap of faith. Second fund, cut down a little bit. Third fund, purely performance. If you're not performing, you shouldn't raise money. It's not about fees. You don't deserve to raise money. Right? So I think we have been told that's about the time we have. So any questions for anybody? Let's go around the room. Do we have somebody there? Yeah. Yeah. How do you do? He's been trying hard to get all of us to come down to Ahmedabad.
Yes. Hi. Thank you so much for the amazing perspectives, and it was very educational. One thing that comes to my mind: how do you see the crowdfunding, model, coming into India in a big way and impacting the existing ecosystem? Thank you.
I'll start maybe, but we can go around. In fact, we were just brainstorming a bit before this session as a group to see how we can use the alumni collective a lot better and funnel capital for founders who may be able to use them. Of course, regulation notwithstanding, because there are some evolving laws around this. But what came out clearly was, rather than focusing on just the campus side of it, but right after a few years of experience, if we can build a construct where founders get access to capital as well as guidance. But how do you do it religiously? How do you do it with a lot of predictability? There's an effort. Today is an example of that. I think today getting so many people in one place on a Sunday is not trivial. So I think especially the team at CIE, the professors here are really putting their back behind this to say, how can we use the IMA brand better? And the effort is on. I think there's a long way to go. And if you guys want to add anything.
The only thing, I do think it is probably, it will grow, but it is likely to be for the smaller checks. Because I do think that the moment it starts getting into meaningful capital, wealth is concentrated, and therefore by definition, it will come. I'm assuming you meant it for the smaller, earlier stages, where I do think you will see more and more of it, yeah.
I personally think it's not a good idea for the average retail investor to put money in private companies which are associated with such high mortality risk. We just spoke about returns of professional fund managers who aren't able to get there. My sense is the marginal money is meeting the marginal startup on most of these platforms. So unless you know something very different as that crowdfunding platform, you have some deep insight into that, I would, as a retail investor, I would say I'd stay away from this asset class.
Amit has a thriving business, so that's why he's asking.
Yep. Love to learn your insight on how it works then.
Yeah, sure.
Look at the companies, there are, I'm using this term for a reason. Obviously, when you look at the company's portfolio and the stakeholders, there are three major things that comes to mind. One is the profitability. Second is the product. Okay, I'm not discounting customers, but third is the people who are the owners and the founders and all those who are running it. So out of these three P's, profit, product, and people, who do you value where, and how do you see when you, after a first round of investment, second round of investment, when things are not going wrong, where do you place them in the order of merit? Thank you.
I think that's a 1 hour session by itself. I would say people first, because there are no profits, not much anyways, because these are growth engines and they need to invest into growth, and hence that usually comes at the cost of even EBITDA profitability, but people with good unit economics in a deep market would be of interest. It's a lot of consensus.
Yeah, it's a very long.
Basically, if the people are right, then they'll figure out what is important when. So in the early stages, it'll probably be figuring out product market fit. In growth and later stages, it might be profitability. Based on the environment, they'll be able to change their decision making. They'll be able to adapt. So for us, at least, I think it's through and through people.
And we are somewhere in the middle in terms of when we invest in company typically when they have maybe 100 crores of revenue. So for us, 50% is the person, 50% is the market. But it's still not profitability at that stage. And we don't have a panelist who's only focused on profits. Private equity, we don't have, but I'm sure at some stage it'll change.
My question is on the dissonance between the managers and the LPs. So, my question would be from the perspective of a founder who doesn't know the internal dynamic that is being played out. So, any advice for such a founder who doesn't know that there is a dissonance between the KPIs, performance indicators of the manager and the partners?
As in the fund manager, the
Yeah,
VC,
fund manager.
LP, they can't be
Yeah.
dissonance.
So basically, he has this deadline that he has to return a certain amount of money, and he got in, but the founder's interest is in maybe continuing for a longer term, and the manager needs to perform in a shorter term. Yeah.
That's an excellent question. I think the answer is communication and a good relationship where founders have to invest into understanding what an investor's life is all about, and even conversations like this today, right? So usually we talk about which sector is going to be hot, how much money will you put to work this year, and how should a founder pitch? None of those questions feature today. So it's conversations, more communication, better understanding, and also I would also add to say that what the media talks about, right? To some extent, we like to glorify. I mean, one is great success, but also all the layoffs, all bad news sells more. I think there can be a better effort in education as well as to how does the ecosystem really grow? How do we become a much more robust, mature ecosystem? Every stakeholder's interests have to be understood. So it's time. You guys have any
Yeah,
other?
I just want to add one thing since you specifically asked, as a founder, what can you know about the investor and his clients, right? I think it's very important to have this conversation because just like how the founder is running your business, we are running our business, right? And this is the investment management business, right? And therefore, the obligations that we are signing up for. So when we say, hey, we're looking to exit or have a liquidity event in 5 to 6 years, it is true. It exists because our funds are, there's a life cycle. It's a 10 plus 1 plus 1 or a 12-year fund. And there is an obligation and expectation, right? And when we talk to our limited partners, we tell them, hey, this is the kind of DPI we are targeting over the next X number of years. I think it is for you to have that conversation and make sure that if, for example, you feel you are a company which cannot provide those outcomes, then maybe you should raise capital from someone else. Because absolutely, see, we are running our business, and our business, our clients are our limited partners, right? And we are serving founders, but our clients are our limited partners.
We thought we are not addressing that today, but here we go. I would also add one more thing on that, which is in a market like today, it doesn't get tested as much. But when there's a lot of options for founders, this gets tested a lot more where if you really invest it, see if you can get 7 term sheets in 1 week, you don't really care. But maybe 4 of them are not relevant. Like if you're a Series A company, should you raise from a venture investor or a growth investor makes a difference. Because a growth investor may have a 3-year time frame or 4-year time frame. But you may want an 8-year time frame to go from there. In a market like today, if there's 1 or 2 options for a founder, it doesn't get tested as much because supply-demand curve is different. You can decide.
Sorry, I think we might have to wrap up in the interest of time. We're a little behind schedule, but thank you so much. If I can just request all of you to huddle for a picture, please. We'll be starting the next session now, which is the panel of Entrepreneur Talks on People. Request everyone to please settle down for the next session. Okay. Perfect. We'll start with the next session. I'm sorry to rush this. The panel members will be available for some networking time after the sessions. Request everyone to please settle down. We'll be beginning with the People's panel now. As we know, startups are disruptors, not just in what they do, but how they do it. We often hear that the best talent is sitting in the highest paying jobs with banking, consulting, or other niche sectors. And yet, time after time, a startup comes along with a handful of people and goes on to achieve the unimaginable, from pivoting products, forging new revenue streams, to making comebacks through extreme turbulence. While talent and skill are definitely at play, startups that succeed are startups that craft inclusive cultures and build leadership that drives their people consistently to achieve the extraordinary. With that note, let's head into our next panel, dissecting people strategies that build or break startups. Please welcome our panelists, Abhinay Chaudhary, founder of Laundry Mate and Big Basket, Rashmi Daga of Fresh Menu, Shyam Sundar Singh, founder of the Agri-Tech Frontrunner Dehat, and moderating the discussion is our close mentor in organizational behavior, Professor Niharika Vora.
All right. I know we have a time constraint, and therefore I was told not even to read out the 3-line introductions we have for the participant, for our panelists. However, I think I think we must credit CI for at least putting a people's panel, because as we all know, this is possibly one of the most important resources that one works with, and also possibly the most ignored. Just by the way the panel, by the way the room composition changed as we went from venture capital to people process. Half the people left, right? Because the belief is that, लोग तो हम मैनेज कर ही लेंगे, पैसा दे दो. Yeah. And I'm sure when we were sort of curating this and asking entrepreneurs what was one of their most important points, I think our experience was the opposite. The most people wanted to talk about, most of the entrepreneurs who said they wanted to contribute to talk about people processes. So, we constantly, I think, face this. This is important, this is relevant, but am I willing to put enough attention to it? And I think I really thank Shyam, Abhinay, and Rashmi for actually saying, yes, we will talk about it, and committing to talk about this. So what we're going to do is I'm going to request each one of you to speak for maybe 8 to 9 minutes, sharing something about your own learning or your own lessons about managing people in your own businesses, including managing yourself. I think we'll do that. And then once you're done, anyone who's sitting in the room and you have a question to ask so that we make it more efficient, I think our volunteers will give out some paper to you. Please write down your question. And I will use my moderator's prerogative to only ask those questions that I think are interesting. So that's what we will do. Very quickly, is there an order in which you want to speak? Shyam will speak first, okay? So Shyam is the co-founder of Dehat, which is recognized as one of the top 50 global agtech brands by Thrive in 2023. Yeah. And all of this he has done in less than 12 years. He started this in 2012 and has now, has created a network of 300 plus agri-input suppliers, 1,200 plus agri-output buyers, and serves more than 2 million farmers across India. I think these are impressive numbers. And to do this all in 12 years, with, I think, very little background in agriculture itself is a commendable thing. So looking forward to hearing from you, Shyam Sundar.
Thank you, ma'am. Hi, everyone. So good afternoon. I think when we were discussing that what shall we focus on, right? I said that why I volunteered for this is primarily because there aren't too many, I would say, examples of building companies, especially from our community, right? For largely for rural areas, right? And agree predominantly in our kind of model, which is, sorry, is it audible? Yeah. Yes. So in our kind of model, which is much more physical than digital, though there is a digital element, it's a physical model. But building a team which can support you over the years is something that I thought that our examples could be something which could be interesting. At the outset itself, let me clarify that team building in every case would be unique. Every problem statement, every sector, every team would be unique. And hence, I will just concentrate on our own experiences rather than trying to make a generalized case of how to build a team. Okay. Now, in our case, I'll try to focus on 4 different areas, right? One, our own experience of building our co-founding team, then building other layers of team structures, especially at the ground level, and then a third part would be the creating and empowering second line of leadership, and then fourth part of building teams where we don't know anything about, right? We don't have expertise of those things, right? But that had become part of functional structure or business model or things like that, right? Right. So that would be something that I would try to focus on, right? On building our co-founding team, right? When we started in 2012-13, fortunately for us, what had happened that within our known circle, a few individuals were interested in agri. It was a very small ecosystem, all were from Bihar, so very small ecosystem. We got connected, and gradually we discovered that building something in agri as it is a passion, area of passion for us. Now, none of us had background in agri, none of us, but all of us had complementary skill sets. Someone having very good experience or very good expertise of at least building expertise in operations, someone in business development or things like that, right? Over the years, right, what had actually stuck and what 2 things which become very important was one, that aspiration of building something which is big, right? That has struck. And two is essentially about staying with each other, right? Having trust and belief in each other, right? So what I meant to say is that whenever you go for your journey or any, our learning is that your co-founders become your partners, become your life partners, right? And having that itself, and they might come from different backgrounds. They might be your batchmate, they might not be your batchmate, they might be your senior, junior, completely different background, or even relatives, right? But that level of trust in co-founders, so that you can trust with everything, right? That had become the main foundation. And building a strong co-founder team, a strong team of co-founders, a strong group of co-founders is especially important. It's like a very, very long journey in a car where you can't stop. So you need different passengers and you need different drivers at different point of time, and which is actually true in our case, right? So that is mostly, I'm giving the time pressure, ma'am. I'm just rushing it, right? So, and hence that part is important. Then the next part of our journey was straight away from us being a co-founder, building a team of ground level executives, because there will not be anyone in between in the early stage of your career, right? Of your entrepreneurship journey. You will be someone who has studied at IMA and having friends which are at different institutions, and then you have to directly work with individuals who might not have a very basic understanding of, even education wise they might not be that, especially in agri, right? You will have, of course, you will work with BSc agriculture and everyone, right? But then they might not be professionally equipped in the way that you want them to be equipped, right? But you still have to work with them. You still have to create like hundreds of such individuals and build them. One thing that had helped us was our own experience of building it from scratch and grounds up journey, and ability to communicate that kind of vision and mission to everyone, right? Especially those who joined us at a very early stage, right? And I'm talking about warehouse managers, field level executives, mostly they. In our business model at the Dehat, we have examples of people who have joined us as office boys, doing essentially cleaning and cooking food for us during the initial phase of time, and now they are taking care of 200 crores of business. Now they have stayed with us, they actually completed their education, they did BSc, MBAs and everything, and then they grew up in their career. And there are so many examples of people, right, who had done that kind of a journey. So it's that phase of life when you bring everyone and you essentially are selling your mission and purpose and vision, right? So at a grassroots level, that had become like our own journey in terms of like how we can communicate that kind of a aspiration to them. Then the third layer of that was around building the leadership team, and that comes much later. That comes when you have sufficient amount of fund, when you have a large problem statements to take care of. And I would say in between three, that is the most difficult part, right? When you have to bring individuals from industry who will, in many cases or in almost all cases, might just be older than you, much more experienced than you. How to ensure that they'll unlearn some of their learnings and learn new things about your business model, especially if your business models are in the uncharted territory. And ensure that they stay motivated, and also ensuring that you are also empowering them. You know that where to leave and where to basically take control of, right? That itself, right? Where do you need to give them empowerment, and where do you still want to be in charge? That has its own journey. There is no right or wrong method. But in our case, we have learned with our own experiences, with our own, and gradually we realized that again the same thing becomes important. That people who are sold the entrepreneur or your ventures mission, right? They essentially will be part of your journey, right? Everything else in the due course of time becomes less important than actually understanding that, okay, what the purpose, why are you here for, right? And then sharing your aspirations. So in a brief, building the second line of leadership, ensuring that they become as empowered as you had been, that is very crucial, and that it takes its own time. And then the fourth part of essentially building functions and verticals where you don't know anything about. For us, for example, like finance. None of us had a background in finance, or even for tech, we had no background of tech per se. How would you bring individuals who can create their own teams? Because that's where, there you have to bring a senior person first, and then they will have to create their team, and trust them with their decision making and skills. Or especially in our case, we are building an export vertical. We don't have any idea about how export system works, but we have to bring individuals who can work on that. So that is again a journey of ensuring that you bring right individuals. You bring individuals who are not just focused on their core domain, but who can also be, one good marker for us had been that if the individual is willing to go or a step outside their core expertise and try to help with other things, it means that they are willing to stay and they are willing to help organization rather than just doing the core activity. So that had become like a good marker for us in that way. Like that's the journey that we have traveled. I remember that there was an year where we doubled our strength, and it became, at some time it became chaotic also, but at some time it also became like so important to focus on how will we ensure that people who have joined us have good experiences. They can learn, they can see Dehat as a learning institution rather than just as a career option. So then we started focusing a lot on L&D, a lot on hand-holding and everything, and we set up our own internal academy for that particular purpose. So all of that had helped us in a stabilizing team when we are in a very rapid growth phase. Right? Yeah. Thank you, ma'am. That's all.
So I think in a very, very short time, you have been able to talk about your own team, the team of your frontline people, and of course the leadership team. And I think in all three, you have made some very interesting points. We'll possibly come back to them as we go along. Thank you so much for sharing. Rashmi, I'm going to call on you next. Rashmi Daga, as you all can guess, is an alumnus of IIM Ahmedabad, and she ventured into the food tech industry in 2014 with the establishment of Fresh Menu. And just in case you wonder what what they serve, their food ranges from Lebanese falafel to paneer butter masala and keto peri peri chicken salad. I'm just saying all this so that you all can feel a little hungry and want to look at her menu. But I think operating 40 kitchens across Bangalore, Mumbai, and the NCR. They have order volumes of more than 20,000, and again, very dispersed business and still running it successfully for the last 10 years. It will be very interesting to hear your story, Rashmi. Thank you.
Thank you, ma'am. I think I'll try and dig in a few bits and pieces of how I think about people at startups, and I think I'll go back to where I started, and especially back on campus. I think a lot of us thought the HR course is like side business and paid very little attention to it. The first 4 years I was at IBM and J&J Medical, and there every time a review meeting used to happen, every time you were supposed to write what you did for the week or what's your achievement, and or the annual appraisal, the huge form used to come. And I think that was a big put off, and I used to keep thinking, why are they asking me so much? Why don't they just let me work? And why do big companies make it so slow and so difficult? And when you run your own startup, and the moment you are above maybe 50 people, and it hits you, because that's when you realize why big companies are big companies and why you are a small company, because there are no people processes. Everybody in the company has a different level of motivation. Most of the times as founder, you start with thinking everybody's motivation is as high as yours. Everybody is self-motivated. Everybody knows exactly what they need to do, whether it's a structured situation or an unstructured situation. And that, I think, is a starting point to understand how important is people and people processes in a company. So I think a lot of my lessons are through one, not liking the entire process at all, to believing that that's the only way to make a business succeed. I've made immense amount of mistakes in my people journey. Fresh Menu, one is in a business which is ops intensive, attrition above 100% year on year. Every month a lot of people leave after collecting money, and it's difficult nature of business where you're constantly trying to go one up on dealing with cooking staff who are migrants. So actually the nature of the business problem solving should have been different. Day one, when we had funding, for example, the easiest way to solve it is, let's pay people more, let's hire the best. So there were people 8 years back, 9 years back, we used to pay at the same role, at the same level of capability, a lot more money than we pay today. Because at that point of time, it is about building the business, survival of the business. Can we prove we can disrupt the business? The economics are very different. Today, it could be very different. So definition of role to the process to hiring, there were a lot of changes that we had to go through and a lot of mistakes that you make. The other big thing that you learn as a founder, you're a salesperson. So my biggest learning on hiring actually came from Bhavish at Ola. I worked at Ola for a short while, and he was a massive sales guy. He is even today. First meeting at 9 p.m. in his office on like a Friday evening. Saturday morning he messages, so what have you thought? Like, I'm still thinking, okay, let's meet for coffee. Okay, sorry, today I'm busy. No, at 10 p.m. I'll come down. Wherever you are, I'll come and meet you. At 10:30, He comes down to meet one night, second night, till he gets, yes, we'll join you. Okay, can you join as of yesterday? So the hiring process and the learning that a founder has to hustle through hiring, talent's obviously hard. Very few people you will find that you have a wavelength match, and you have to convince them all out that, they need to join you. So hiring is like a big force multiplier in the company. As a founder, in last 9 years, I think I would have spent about 20-30% of my time hiring. Most of the time goes in hiring, figuring out sources of hiring, meeting people, traveling to where they are. A lot of times, the supply and demand is a challenge. So if somebody says, I live far off, okay, I'll come and meet you 2 weeks later. No, I'll come where you are. आप बताओ कितने बजे मिलने आना है. So hiring is, I think, a huge piece of this whole puzzle. And I think solving for people, another learning, and that's a very tough one. You have to shrink your ego to this size. Like whether you like something, don't like something, things are going well for you, not going well for you. You have to go to your people and say, all is well, or everything is going to be well, and we will make it work. So your egos have to shrink a lot, which most of the times as employees or as team members, you don't have to deal with. It's most of the times only when you become a founder and you have a team to deal with, and you have a lot of circumstances around you that you need to deal with, you'll realize that that's, I think, first way to solve for team and retain a team or build a team. As a company, some of the difficult lessons we learned, and obviously when you're on an upswing, when there's things going well, answers are very different from the team, from your side. When things are difficult, when you know that the money is run out, we didn't have money, and then COVID had hit. So we knew we literally had to figure out every month, how do we survive? Do we even try to survive or not? Do we exit to somebody? So you can run parallel conversations in your head and manage the equation. And one thing that was hard hitting was first time in COVID when we had to go and announce to the team that we will have to let go people due to the COVID downturn. And for a couple of months, we want to cut on salaries and we want everyone to take home less money. And couple of guys just walked in and said, "आप हमको क्यों कम पैसे देंगे?" It's like, sorry, we don't have money. But आपने पहले profit कमाया होगा ना. So that hits you because, all this while, you're trying to build a business for growth, for other metrics, and profitability was not the most key number. And even if you tell them कि हमने पास में कोई profit नहीं बनाया, उसको क्या फर्क पड़ता है? उसको इस महीने का पैसा चाहिए. So India is actually a very difficult country where hiring is actually technically way easier than firing people or reducing pay or having this difficult conversation, because 99% people on the ground don't understand profitability, don't understand unit economics that you discuss in your boardroom and with your VC. So that, I think, is a life lesson that I'll take कि past में profit नहीं बनाया था क्या. So I think these are lessons on people. Obviously, you can go on and on. नहीं, हाँ. Those also. So when you interview people and said, "Madam, हमने तो internet पे देखा, आप IIM अहमदाबाद गए थे." Like, yes, but आपको देख के लगता नहीं है. It's like, yeah, I should have had horns on my head. There were times when I used to do sales in IBM, and some client would someday trying to chat, okay, what do you do? And, अच्छा, आपको देख के लगता नहीं कि आप IIM गए थे. आप उतने he literally said, आप उतने intelligent तो लग नहीं रहे हो. Because most of the times you're trying to not, okay, maybe as someone who was always trying to not look like, you carry a chip on your shoulder that you went to a premium institute. A lot of times it hits you back because people say, आपको तो देख के लगता नहीं कि आप इतने intelligent हैं.
Thank you, Rashmi, and again for bringing up some very interesting points about how do you manage yourself, especially, your own ego, and also how this is a sales job, no matter what. So we'll again come back to talk about it. And with that, let me introduce to you Abhinay. Abhinay is currently the co-founder of Laundry Mate, a leading on-demand laundry and dry cleaning service. He has a background in management at Big Basket, which I'm sure all of you know is India's largest online grocery store. He has also extensive experience in scaling operations, building strong delivery networks. And among other things, he is a sought-after mentor, advisor, inspiring and empowering aspiring entrepreneurs, and has remarkable achievements to his name. Looking forward to listening to you, Abhinay.
Thank you. So I will just touch upon some of the other areas related to the people side of it. And I guess, I mean, for all of you who are here, I'm sure you are either already running something or plan to run something in future, right? So, so how do you really kind of, as a founder, co-founder, kind of deal with this whole people thing? Because without people, no business, right? I mean, you are the first one to start something, but whatever you have planned to achieve, right, has to be achieved by the rest of the people, because you alone would not be able to do much, right? It's the people who you hire, who work for you, the way you manage them, the way you deal with them, right? How do you replicate yourself, on those within those guys? So you kind of are replicating yourself so that you, are kind of increasing in force, right? So you need to get people who can, deliver, right, what you are planning to set up. So the whole focus when you are a manager in a corporate, wherein it's all, how do I do well and how do I grow, versus when you are a founder, it's how do I make others, perform, not just up to what potential, but higher potential than, what they're. So your entire focus is to make sure that the people you are hiring perform, above their capability, right? They hit above their kind of, so that's the whole focus change in terms of how you need to really deal with people. And these will be all kinds of people. I mean, it's again, unlike, post MBA, when we are working in MNC and all, you are dealing with a certain level of people, right? They have an understanding of the business, their understanding of processes, understanding of some of the basic things. But when you are dealing with somebody who is, let's say, 10th pass, 12th pass, and you want to have that guy, work beyond his potential, and you have to motivate that guy, you have to have a very different approach to deal with. So especially when you are operating operational heavy businesses, as talked about. So similarly in Big Basket, the whole the operations was kind of dealt by the warehousing staff and the delivery staff, and all of them obviously are very, very, very less educated, right? So being able to really play a role wherein you are able to identify how do I make each of these individuals perform better, understand what day-to-day problems they are facing in the job which they are doing. One is to say, okay, here is the job, here is the process, you deliver, you get salary, and end of the story, right? But then trying to really understand on an ongoing basis, what are the problems this guy is facing in doing his job, right? And then have that dialogue with each one of them at a frequent interval to understand and give him a sense of that, look, we are here to solve your problem. So when you are able to really kind of discuss and solve his problems is when he will be more committed and he will deliver better, right? So across the levels, I mean, this applies across the levels, because the kind of problems which will be faced at different levels very, very different, right? So now with all the tech-enabled businesses, I mean, we have people, who are coming in from, all parts of the country. They don't know English, they have never handled technology, but then you suddenly give them, to follow processes, do delivery app, this and that. Their life is very, 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 very complicated, very, very challenged, right? And so how do you make sure that these guys are motivated enough, right, and solve their problems, right, on an ongoing basis? So that's I think a very, very different role from a people perspective when you are a manager versus when you are a founder, right? So also whatever you want to achieve, right, especially in a tech-enabled businesses, the team out there is actually really the face of the brand, right? So what they do, how they interact with the customers, right, is paramount, right? And you have to make sure that each one of those guys deliver it the way you would want. right? So you have to kind of get into, their shoes that, when you as a customer walk into a store, how would you want the store manager to deal with you, welcome you, so that you will go back to the, if you like the store guy, you'll go back. Similarly, when you go and deal and deliver to your customers, right? How do you interact with them? How do you, make them happy? How do you, so that the customer satisfaction is there, so that they can keep coming back to you? So there are a lot of such level of detail you have to really get into. How do I make these individuals perform better on an ongoing basis? Just to give you a few minor examples of the entire, the big basket delivery side of it, right? So we had to hire each of these people because there was no logistics players available to cater to our requirement of delivering grocery at the doorstep, wherein you are dealing with all kinds of products with the chilled, frozen, heavy stuff, right? And carrying that stuff is very, very difficult, right? And they have to deliver on time and everything, right? So getting down to the details of when they interact with the customer, when they go to deliver, what all we should take care of. So most of the houses obviously would want these people to come inside, right? And then because we didn't have any carry bags, we were delivering in crates, and the guy has to empty the crate in the customer's house and bring back the empty crate, right? So most of the people will say, come inside the house. So when you will kind of really looking at the uniform, what uniform the guy should wear, you will obviously have shoes and socks for the guy, right? Because you want to make him presentable. But when he has to go inside the customer's house most of the times, right? Then Indian culture, you want to remove your shoes. So this guy would not obviously wash his socks every day, right? So that's the situation, you have to deal with over there. So how do you really get down to the, that level of detail? Say what should be his uniform so that he's able to do the job better. Also, when he goes and delivers, he has limited time, right, to deliver things, and because he has to deliver that many orders, so how do you really, train him in terms of how to quickly deliver the order to the customer? And because everybody want to check, if you have an order of 50 items, then you want to check whether they have delivering 50 or not. And if there's a kid around, then that's a game also, right? They are playing, okay, please, right? So, but the guy has to deliver and go fast. So some of these things, I think, as co-founders, we have to really get down to the very lowest level of detail of every individual's job and try to understand how do I make this guy's life easier, how do I make his job easier, so that he is able to perform better, right, than what he's capable of, right? And those are the people then kind of really, when they get confidence, you'll have people from all walks of life, they have no confidence, they never worked in an organized. So when they see this kind of a help and support, then the commitment kind of really goes up, right? I mean, a lot of other white collar, interactions, managing all, I think we all do have some exposure and do learn, but how do we really manage the blue collar stuff, right? By these things, also from the metrics, right? Or keeping really tap on all the metrics of each and every individual and trying to, ease their way of working. I think is the biggest thing which, as for co-founders, we need to really learn. Thanks.
All right. So before we get into questions, and I'm sure there are some questions that are here, I heard all three of you speak about managing the frontline staff, right, which is the blue-collar workers in most cases. And of course, those are difficult because to some extent, I think our own experience and our own familiarity with handling them is low. Can you also talk a little bit about managing equals, managing your own peer group, and issues that might be prevalent there? Any thoughts, any three of you?
No. I think managing equals as well as seniors, I would count in that, right? And because especially when we start young, and then we definitely hire people who are very senior to us, right? And I guess, and we have learned over the years, but our current understanding is this, that, the level of professionalism and open communication, right? Those things matter a lot. In a way that, even if anyone comes up, right, whether they are even your batchmate or whether they are not, at the end of the day, you are going to hire those individuals. Other than your co-founding team, you are going to hire multiple leaders, right? and many of them would be your equals or seniors. But what you expect from them, and that needs to be communicated very openly, especially what you expect from them. Being a co-founder, this ability to communicate that from them, what are your expectations, that becomes that becomes the primary thing. The second thing is for them to have a channel where they can talk about their own concerns, challenges, aspirations. Those channels can be you, can be someone else, right? Can be the HR person, right? Or some other person in them. And then the third part of that is that how you can, from time to time, right? From time to time, how will you ensure that you are, as I was saying previously, that you are trusting them with some decisions, as well as you are having an overview of some of the other decisions. And how would you ensure that that process is well set, is transparent, and is happening? Right? Because that's what it will happen, right? You will bring, you are doing sales for yourself, and then you will bring a sales head. So it will not happen that on the first day itself, you will transfer all the sales ownership to that person. But having this process of giving the visibility that, okay, with time, these things will happen, and you are sticking to it, you're sticking to those milestones, right? That itself is important.
Yeah.
That had been our journey.
Yeah. Well, I
Have one, sorry. One of the things that does help a lot is engage with a coach. As a founder, I think you can take a lot of liberties, but once you're a people manager and you want to run a large people organization, I realized that coaching helped me deal with my own self better. I knew what works for me, what does not work for me. You are able to make your progress as a CEO, and I think that allows you to deal with people younger than you, older than you, less capable, more capable, in a different way, and helps you progress in this journey of building this company for long term. And I think that difference between a founder and a CEO starts coming in the moment you are ready to deal with it. A lot of times we ourselves think we know everything and we can solve everything first principle, but I think coaching was one thing that really did help a lot.
So investing in yourself and constantly playing the dance between leading and letting go. I think that's some of the things that we possibly need to focus on. Okay, I think I see a lot of questions, and I'm not going to ask you to respond to it, but because there are many interesting questions. There is a question that is coming from many people, I can see that, and that is on after you've selected the right talent, how important is the development journey of these people? How much do you invest in it, or do you really let it be because some of them will leave you very soon? So there's that whole aspect of how much to invest in people, in their development.
My quick answer to that, I think startups, and whether we like it or not like it, I think we are playing the survival game for most of our time. Investing in people development and putting a long-term development plan is usually impossible. I think you hire for those 12 months, 18 months in mind of what would work at that point of time, and you've selected your typical selection process is people who are self-motivated, people who will hustle, and people who will go for it. You should also be prepared to fail fast. Whatever amount of time you put on interview and the right selection process, you make wrong hires. I think it's better to fail fast and to let go early than to drag and suffer for the entire organization.
I mean, yeah, so people development, whether it's short term or long term, is of course very, very critical. So you need to really invest in all spheres. I mean, in terms of the giving the right training, right tools, planning for their career growth. Because also when you are really hiring in large numbers and everybody wants to see a career progression, right? That's when they will be able to stick longer with you, right? So I think you have no choice but to really definitely invest each one of them to be able to, have them for a longer journey. Yeah, but yeah, as Rashmi is saying that there will be attrition and all, you have no choice. But at the same time, whosoever is there with you, you need to make sure that they are performing to their potential. So you need to really kind of keep on investing in them. And even if they leave early, I mean, you can't help it, right? So, but you have to invest.
I'd like to add one point, right? So we work in a different industry, and we don't have a lot of blue-collar workers, right? We have entry-level people, freshers and all. But then we also work in an industry where most of the large companies, you will find that their MDs and CEOs and very senior people have started their journey from being a sales executive, right? So that kind of becomes an indicator for us that whoever is joining at that level, if we invest in those talents, some of them would give us, or some of them will become very important leaders in future. And the other point is that we have also worked in a place where, generally when people come, like for example, in our agri input vertical, when they come from a specific background of, say, experience of selling seeds. And then when they come they have to work across multiple categories, right? So learning, ensuring that they are learning fast, they are learning in a very structured manner. I mean, we are also at a WIP phase, right? It's a work in progress. But for us, that becomes so much important even on a very short term. And hence that's something that we try to ensure. Yeah.
So managing people's expectations and learning journeys is one thing that you're saying is very important in this. I think there is a question here which says, there are 3 questions that I want to ask. One of them is, what are some ways to put people out of their comfort zone when despite every effort, targets, etc. that you set for them, they seem to be in their comfort zone? So how do you make people uncomfortable is the question.
I mean, usually does not apply to a typical startup. Because right from the top, founders to down the last level, everybody is kind of not in their comfort zone, right? Because every day you're dealing with new challenges, new things, right? So, I mean, especially in a very fast growing kind of a startup, right? And that journey continues for a while, right? So, but I mean, yeah, it's, if you really find somebody who is able to, kind of quickly learn and, adapt to what is being, then throw more challenges, because there is no dearth of challenges actually in a startup, right? So that could also be a faster growth path for the guy, right? And you set kind of role model and, from that perspective, because if somebody can do multiple jobs with just one salary, I mean, you would welcome it, right? So start off with founder, right?
No, same. Changing role, changing job.
Okay, so make it challenging, for them. Yeah. So here's a question from a current student who's saying, right now we are into the era of AI, and in future there won't be anything we won't be able to do with AI. I mean, whether it's true or not, but that's the assumption that with the question is being asked. So as a student from IMA, what should we tap into, that is skills, knowledge, where we should focus on so that we're able to deliver superior or similar value, at least, as to what AI could deliver and what they could deliver? I think that's the question. Yeah?
I'm not sure that I have understood that, yeah.
I mean, it depends upon the nature of the business, right? So the kind of businesses, I talked about, Rashmi talked about, where there's a huge human element in terms of the operational, can't be replaced obviously by AI, right? Because ultimately, if something has to move from point A to point B, no AI can move it. It is the people, individuals. So if there is a huge physical element, operational element in the business, then whatever obviously we talked about is pretty much relevant. People management will continue. Even if you have AI, I think people management would be very, very critical. And that actually kind of sometimes really makes and breaks, including as we talked about, the co-founders, the people you kind of really work with. A lot of startups fail because somehow the co-founders could not gel together. So I think irrespective of whatever happens, AI or no AI, I think people management as a skill, as a key thing is important to learn, and hence please focus on OB and HR classes.
Yeah. Well, thank you for doing the marketing for me.
Also, I think, sorry, so AI, I honestly, if we learn application and if we learn, AI will not take away management job, or if you just put back in startup context, we are all trying to move a mountain. A predictable answer on an algorithm based answer, if it was going to predict it, nobody does a startup, right? So honestly, people like us exist because, we bring motivation and we solve a problem that otherwise look like nahi solve hoga. So I don't think AI is really a challenge in that aspect. Plus, India as a country, I think there are enough and more physical problems to solve, physical efficiency to bring. So I think this generation need not worry. Maybe your kids need to worry about it.
Okay. And I think there's a specific question for Rashmi. And the question is that Cloud Kitchen has many challenges. And the question is there more, and yet is there more scope for growth in this segment? And how can some of the problems be solved is the question there.
That I think would need another session. I can tell you when we started, a lot of people used to say ki acha to aap tiffin bhejoge, like you go back and think that women will do dabba service. I don't think we were able to explain to people at that point that Cloud Kitchen is a phenomena where so much more of home food will get replaced with food that is getting made outside the kitchen. While all of us started with, this mega statement that restaurants are here to die and we will kill the restaurants, I don't think restaurants are here to die. But cloud kitchens will survive because more and more of you will cook lesser and lesser meals at home. And for the size of this country, we need more and more outside food to come in. That itself is a huge growth opportunity. I'll not get into the numbers of what's the frequency of meals, etc. The business has challenges. People want all online stuff to be cheap. So delivery food is still earning much lesser per meal than what we pay outside. And that I think is a bridge that we would need to cover. But otherwise, it's a business model like all other food business models, definitely has positive unit economics. There are fixed costs in their scale and there is, consistency that we need to solve for. But that is why we are solving for it. And there is no single straight smart answer. It's an iterative answer.
Thank you. I think with this we should try to wrap up. One of the questions that has come up again as a resonant is, do you hire for skill or do you hire for attitudes? And one of the things I heard each one of you say, which is an interesting point, that do not assume that people who are coming to you are motivated. You have to do something to motivate them. And what you're also saying, and very interestingly, that none of you actually said we motivate them with money. You said you motivate them with showing the bigger picture, with getting them to align with the vision or the mission of the organization. And each one of you spoke about the passion that you had and you were able to grow in other people. And obviously these are these are good statements to make, but when we start to think of how do I get others to be as passionate as I am, do I select for it, do I grow in it, do I do something, are interesting questions for us to think about. I don't think anyone has answers, including us, have answers for it, but I think these are important questions for all of us to think about. But I think what you also ended up, all three of you said was, it isn't rocket science, but it is a problem that definitely needs to be paid attention to. In fact, Rashmi, you said you spend 30% of your time on just hiring and people issues. How much do you think you spend?
I mean, I don't have a specific number, but I mean, most of the time we are actually managing people, not
People.
just, I mean, hiring is what I think we talked about in terms of time spent in hiring, but once you hire them, you are always, mentoring, discussing, motivating, so,
Sure.
so yeah, I mean, very high percentage of time, almost 40-45% is kind of dealing with people, right? So that's the...
Most of the times I can't talk back once I reach home. I can't already
Talking.
No, internally, we say that, those who have like 50 to 100, more than 50 or 100 people in their team, essentially they are not a business owner, they are an HR person, right? They have to manage their team in a way that an HR does. So that's the statement. And in general, for us, like most of the time that gets utilized in terms of aligning people, right? So people management itself takes a lot
Right,
Yeah,
right.
thanks.
So I think what we're learning here, and maybe we will all talk about it as we go along, is that maybe setting up a business is one part, but then to keep growing it, you really have to start to look at people. So money may get the business started, but it is the people who actually keep the business running. And therefore, you all have to be good people managers. Thank you so much.
Thank you so much. If we can just get a picture of all of you together.
Are we supposed to come to the front or?
Thank you. We will swiftly get into the next session. This will now be the last session of the evening. This will be a panel on profits, the entrepreneur talks. So request everyone to settle down for the last session. We'll get started. Yeah. Yeah, you can join us on stage. So starting with the entrepreneur talks on profit, we'll get started on this if people can settle down. Legend has it that 3 magic words summon every founder and VC in town: profits, profits, and profits. Profits are the ultimate test and testament of a startup success, and that statement needs no further explanation, at least for the present audience. If it's not profitable, it's not a business. Yet, this simple logic proves to be the trickiest to execute. So, on the way to alls, let's ask our panel if there's a red brick road to profitability and success. Please give a warm welcome to our panelists. Sandeep Gupta of Innovasa, a leading digital healthcare company based out of Silicon Valley. Amit Lakhotia of Park Plus, a leading one-stop platform for car owners' every need. And Sanjeev Agarwal, founder of Amplus Solar, India's leading distributed energy company, and Hexa Climate as well. Inviting Professor Amit Karna as well to moderate the session. Over to you, Professor Karna.
Thank you, Ashna. I thought there were more people interested in money here, but that doesn't seem to be the case. Or maybe they've given up on it. Okay, thank you all for being part of this panel. And as we have chosen each of this panel to focus on certain theme, here the theme is what perhaps the holy grail of business per se is. And as I guess all of us are aware of the value of death. So for the next 30, 40 minutes, we're going to try to see if there is a way to traverse this valley of death, right? And we couldn't have asked for a better panel because three PGP alums, 1995, Sanjeev, Amit 2007, and Sandeep 2011. All three of them with three different sectors, having worked in different companies and started their own. So what we'll do is, in this panel, we will have each one of them talk about their journey, what they have learned, the insights that they've gathered while trying to make money for themselves, for their investors, for their other shareholders, and what are the different dilemmas, the trade-offs that they have faced as they traverse this journey. Just a housekeeping, we'll have each one of them speak for about 7-8 minutes and share their thoughts, and then the team will collect the questions, and I'll read those questions out. Eric there is happy to collect the questions from you. Also, we have the panel where so Sanjeev, for example, has had a profitable exit, right? So there is hope on the other side of the tunnel. That's what the message is. So he'll talk about that. So Sanjeev has been in the energy sector, co-founded Amplus, and then had a profitable exit and has co-founded Hexa Climate Solutions. Amit Lakhotia, his 2007 batch, has actually worked with Make My Trip, and in fact, we were just talking the other night. We actually overlapped when I was a student here, and he also started his profit journey from turning around the entree store on campus, right? And that's where he'll maybe speak about that. But he's had a very interesting journey with Make My Trip and Paytm. So in fact, he was the guy behind the Paytm wallet when it began. So he's been at the top management of a couple of unicorns, and then he has started on his own, which is Park Plus. If you guys have seen it around, very visible in many of the parking lots currently. And Sandeep also has a very different perspective. He will share, of course, I won't get into that, but he's started Innovator, also was one of the Young Alumni Award winners, where he's catalyzing innovation in healthcare and runs a startup out of San Francisco, right? So, which is in a way the heart of capitalism in the startup industry. So why don't we start with you, Sandeep, that what is your view on how to traverse this hard journey?
And great to be back at the campus and speak on this. First of all, I'm just happy that our session did not get cut off, because profitability to ज़्यादातर के लिए यही हो जाता है कि startup I was like कि अच्छा product हो जाएगा, people हो जाएगा, लगा profitability कट जाएगा, लेकिन नहीं, good, I am happy that we are finally talking about it. So again, I'll give you a quick brief about the company Innovator that I founded. So it's a vertical SaaS company. As a vertical SaaS company, we work with healthcare, primarily in the US. And again, from a stage perspective, we are Series F funded. We actually ended last year with a revenue of $140 million odd, so pretty scaled up from that perspective. We started in the year 2016. So it was after a few years passing out from the college. Now, if I had to think about the journey at Innovator, I would divide it into 3 parts. The first part was the 0 to 1 journey, which was about finding what is our product market fit, and we had multiple pivots before we could land on this. So we started as a horizontal layer platform. We started and we have always been a B2B company. So not a B2C, a B2B, a hardcore B2B enterprise grade software company, right? So we started servicing customers in India. From India, like paying power is a little lesser, so we transitioned to the US. We were industry agnostic. Finally, we stumbled upon healthcare, and within healthcare, then we scaled up. So it's a journey that from 2016 to 2018 was the 0 to 1, and we were at $1 million in 2017. And so that's the first part, and I'll not spend too much time on the pivots and everything, because that's not the intent of this discussion. The second journey was growth at all cost. which kicked in from, let's say, somewhere around 2018 till 2022 Q2. And there's a very interesting story that I had. It's about one of the pitches that we were making for a Series D as in Delta, Series D funding. And it was with it would have been good if the VC community was here earlier. They left, but it was, I'll not name it, but you can guess it is one of the banks that is not hard. So you know who am I referring to. But we were making the pitch to them about investment in the company and what have you. And the entire conversation went like this. So we were like, हाँ मतलब $30 million का burn है हम लोगों का, and 3 साल के हिसाब से 100 million की funding and what all we were looking for. And they were like, अच्छा फिर तो ambition छोटा है. And we were like, नहीं यार मतलब revenue तो बढ़ रहा है and what have you. So 2018 to 2021, not just for us, but the globally was a phenomena when capital was very cheap, and the amount of funding that you needed was like, again, 2 factors. A, जितना ज़्यादा आपका burn होगा उतना ज़्यादा venture capital पैसा डाल सकता है और उतने ज़्यादा आपका valuation होगा. So it was like a recursive cycle. कि when we heard that comment कि नहीं वो तो छोटा burn है, तो हमने कहा कि अच्छा 2 दिन दो आप, अभी वापस आते हैं तो 30 का 300 कर दिया. तो वो तो यार Excel में कितना टाइम लगता है करने में, right? So the moral of the story being, it was growth at all cost. It was कि यार कोई फर्क नहीं पड़ता, खर्चा करो जो करना है, लेकिन your growth should be. Now that did help us कि from like whatever $4-5 million in revenue, we grew something like 80%, 90% year over year, and अच्छी तरीके से growth हुआ. But the challenging aspect of that was कि as the growth was coming in, like हमारा burn rate भी बहुत ज़्यादा हो गया था, right? Like just to give you a sense, 2022 में our burn was roughly, we were burning $85 million a year, which is a very, very big kind of burn rate. And we did have enough capital in the bank कि हाँ 4 साल चल जाएंगे अभी from a burn perspective. But in 2022 came in the 3rd leg of the journey. And that journey, which I say is the balanced growth, and which is actually the title of the conversation also I want to have. So we went the 0 to 1. Then the second was growth at all cost, and growth at all costs se fir transition hua into what we call it as the balanced growth. Now what is balanced growth, right? So not for any fault of ours, but in the entire ecosystem, US Fed rate, as we are aware, बढ़ गए, right? The moment US Fed rate increased, what that meant is that the era of free capital was no longer existent. Kyunki, like for obvious reasons, somebody will put it in a risk-free kind of a return and still get 4-5% with the US Feds, तो कोई startup में क्यों डालेगा, right? So for your net present value and all those kind of stuff. Moral of the story, 2022 में the going stance ended up being कि if you are not profitable, it doesn't matter whether you have capital or not, आपको कोई पैसा देगा ही नहीं, right? So that became a 3rd part of the journey, which was कि हाँ ठीक है, growth अच्छा है, लेकिन at all cost does not make sense. It has to be balanced. And that's where we learned a new terminology, which was rule of 40. Now, rule of 40 said that, okay, you know what, it's a summation of 2 things, which is आपका growth rate कितना है year over year, plus amount of EBITDA that you are generating. So let's say if you are growing whatever 80% year over year, but you are burning 80%, तो आपका rule of 40 पे 80 minus 80 0 हो जाएगा. Similarly, अगर आपका अगर 40% growth rate है लेकिन आप 20% ही cash burn करके दिखा रहे हो तो आपका 20 आ जाएगा. And what immediately came into picture was कि rule of 40 पे only the companies which are 40 or more aspirationally or are over there are only the companies that will be long-term sustainable. So this started in Q3 of 2022, which is like what, 6 quarters back, and immediately the transition happened कि अच्छा ठीक है आप cost cutting करो and bring it back. Now as a startup founder who pretty much has been focused कि यार growth at all cost and people, I think that became a very, very challenging part of the entire equation. I think somewhere along the line, even at being that scale, even we had, most of the other startups and companies had forgotten that profitability is the key why you exist in the business, because if you are losing money, that is bad. मतलब आई लेट दैट सिंक इन द अगर आपका स्टार्टअप पैसे नहीं बना रहा है एट द एंड ऑफ द डे विच इज बॉटम लाइन, देन यू विल नॉट एग्जिस्ट इन बिजनेस. आई थिंक दैट फैक्ट नॉट ओनली फॉर द फाउंडिंग टीम बट द एंटायर मैनेजमेंट टीम, वी हैड टू ड्रिल सो डीप into each one of us. And once that got drilled down, then we started a lot of action in terms of कि अच्छा ठीक है, अब unit metric को देखो डिटेल में जाके, where are you burning cash, how can you reduce the sales and marketing. Maybe you will have to take certain actions that okay, you know what, growth rate profile 70% की जगह घटा के 60% कर लो, 50% कर लो, लेकिन आपका burn rate profile कम होगा. So I think the third part of the journey that we undertook 6 quarters back to where we are today, where we are break even, I think has been a very, very kind of a deeply enriching experience for the company. And जब आप एक बार प्रॉफिटेबल हो जाते हो, द अमाउंट ऑफ सेल्फ कॉन्फिडेंस दैट यू गेट एज एन ऑर्गेनाइजेशन इज इनकम्पेरेबल. क्योंकि उससे पहले आपको लगता है कि यार कि अगर इन्वेस्टर ने पैसा नहीं डाला, ये नहीं हुआ, तो आपका कल क्या होगा किसी को पता नहीं है. लेकिन वंस यू स्टार्ट जनरेटिंग कैश, देन प्रीटी मच यू कैन कंटिन्यू फॉर एज लॉन्ग एज पॉसिबल, कंटिन्यू टू ग्रो एंड ऑल दोज काइंड ऑफ स्टफ. सो अगेन फ्रॉम अ प्रॉफिटेबिलिटी परस्पेक्टिव, आई थिंक इट वॉज अ वेरी हार्ड लर्निंग फॉर अस in terms of why it is so important, but in hindsight it was the best learning. And I think in future जो बीच वाला phase हो गया था, growth at all cost, unless it is some miracle that happens or you are in an early stage, most of us need to understand, learn and grasp कि profitability is key. आपका unit metric should support it and you should drive towards it. So yeah.
Thank you. Thank you, Sandeep, for it's good, very, very interesting insights, and we'll come back to both the 3 phases and the rule of 40. Maybe I'll request Amit to first share his views on how he sees this journey and how hard is it.
Sure. Thank you for inviting me here. I run Park Plus. Park Plus, what we are building is a super app for car owners. So everything around your car should be on a single platform. Car is more like an emotional asset for everyone. मतलब नीड भी है, ग्रीड भी है. हमारी पब्लिक ट्रांसपोर्ट इसको नीड बना देते हैं. मतलब एनीबडी हु इज एट अ सर्टेन लेवल एंड अबव फाइंड्स इट वेरी हार्ड टू यूज द पब्लिक ट्रांसपोर्ट इवन इफ यू वांट्स इट. और ग्रीड तो पूरी है. मतलब हैचबैक वाला सेडान लेना चाहता है, सेडान वाला एसयूवी लेना चाहता है, एसयूवी वाला और ऊपर जाना चाहता है, 10 लाख वाला 25 लाख की गाड़ी चाहता है, 25 लाख 50 की चाहता है, 50 लाख वाला करोड़ की चाहता है. And endless, this is endless. And earlier people were buying cars once in 10 years, now people are buying cars, switching cars once in 3-4 years. That's happening. And more importantly, the whole family is involved in making a decision of when to buy a car. मतलब आपका बच्चा बताएगा आपको कि सनरूफ चाहिए, बीवी बताएगी ये कलर की चाहिए, एंड मदर विल टेल यू कि इसी डेट को आएगी गाड़ी, न इससे पहले आएगी न इससे बाद आएगी. And this is one of these things, like socially also, if you are doing well in your life, like people will see you upgrading kind of a thing. Public congratulations, these are one of the few things where you will get publicly applauded. अरे भाई ने गाड़ी ली है, congratulations, आज तो पार्टी बनती है. So this is the process till the time you have bought a car. Everybody is happy. But once you start managing the car, then the problem starts coming in. The morning, the car wash guy doesn't turn up. At every point of time, you want to take out the car. The first thing in the mind is whether I am going to get a parking spot or not. अब हर जगह कैमरे लग गए हैं. Like an average Delhi car has 5 challans. Average Delhi cars. And typical average challan is $2,000. 10,000 के चालान हर गाड़ी पे है. The challans have gone up from 100 rupees per challan to 2,000 rupees. As a result, nobody pays. So less than 10% of the e-challans from the cameras actually get paid. But challan is a problem if you get stuck at the road at the, like for example, 8 o'clock, you don't know whom to approach. This is one of the businesses where the frequency is very low, like servicing guy once in a year, insurance guy once in a year. Internet businesses can't build trust, can't build a brand if you don't have a frequency. So we thought, why don't we help people manage their whole asset life cycle around the car? So we started with the most frequent use case, which was around parking. I raised about 11 million when I started in 2019. And the whole use case was, लोग parking करेंगे तो parking के लिए app खोलेंगे, and then that's how we'll acquire the users. 2 months we raised capital, COVID happened. Nobody is going out. किसी को parking नहीं चाहिए. So everybody is like, what to do next? And then we got into we did a lot of experiments, things around vaccination drives in cars, etc., etc. In fact, 2% of whole Gurgaon population got vaccinated in our cars. Sitting in the car, you just sit, and the vaccines, like we saw like 90-year-old ladies coming in their cars just to get vaccinated and all that kind of stuff. And we started with then the access control use case. Access control is making sure the barriers go up and down seamlessly. Then we started with parking, challans, car wash, FASTag. Like I had the background in payments because of my Paytm journey. I built the whole Paytm wallet journey. So like, why should I get out of the car to make any kind of payment? Why should I even roll down window of the car to make any kind of payments? Whether it is toll, whether it is parking, and going forward, whether it is petrol, whether it is PUCC, anything. Why should I roll down the window of the car? I should not even talk, I should not even speak, the payment should happen automatically, kind of a thing. Today we would have close to about 1.5 crore car owners on Park Plus platform, and that's roughly about 1 in every 3 car owners in India is today on Park Plus. And from beginning, like I had experience of what has happened at Make My Trip, Paytm, Tokopedia because of my previous stints. So I was very clear from beginning that we are not going to spend money on consumer acquisition at all. So the biggest expenses for internet businesses are 2 expenses. One is how do you acquire consumers, and second is how do you retain and engage those customers. And we said we'll not spend money in acquiring a customer. Harder route again, so very little of digital marketing, go the offline route, which could be access control. Like for example, we put barriers in your societies. So societies force you to download our app. मतलब वो पैसे भी देते हैं मुझे उस और customer भी देते हैं. Same thing happens for malls, same thing happens for offices, then things around FASTag. Like today, every 6th car in India carries Park Plus FASTag. What we did was to make sure that when you when you take my FASTag or Park Plus FASTag, you have to download a Park Plus app to activate it. So build those flows seamlessly. One of the recent use cases for us is like valet. Now all of us would go to like top properties for food and everything. आप ताज जाते हो, 15,000 का खाना खाते हो, ताज उसमें 12,000 रुपये बनाता है. और खाना खाने के बाद क्या होता है, आप बाहर आके खड़े हुए आते हो, उसको टोकन देते हो, then you are waiting in 45 degrees. It may take 5 minutes, 10 minutes, 15 minutes to get your car. Why can't you be just sitting inside, press a button on the app and say, get my car? And when car comes in, then you go out. You don't have to be standing outside. But that again means you have to download Park Plus app. So just keep building those use cases, keep building those flows where Taj is paying you for the valet. And Taj is also making sure the customer downloads Park Plus app. So now we are accepted at close to about 2,000 new car dealers. So every 4th car that gets sold in India today, the dealer will tell you to download Park Plus app. We are now getting into servicing, insurance, etc. So sizable B2B2C stuff and a bit of B2C stuff. So, but couple of things that have also happened is to make sure the flows are very, very seamless. Consumer should just love our flows. मतलब customer obsession, scale, and all those things, I think that has been very, very central for us from beginning. मतलब we would have 5 lakh plus reviews on App Store, 4.6 star rated app. मतलब it's among the highest, actually it is the highest rated, highest downloaded, highest reviewed, highest transacting auto app in the country, and by a far, far margin. So that is the part so far around the scale, user engagement, etc. So we have solved that part of the journey. कार में finally पैसा जो बनता है and मोटा पैसा जो बनता है, which is around car buying, car selling, servicing, insurance. These are large ticket items and these are large margin items. Insurance you make 30%, servicing you make 25%, etc. So over a period of next 6 months, 12 months, the idea is to make sure that we get those kind of use cases on board. Along with this, build more stuff. Like for example, roughly, the government data says roughly about 2.5 lakh people get killed in road accident every year. Now, this is the official data, so an official number would be maybe 15 lakh, maybe 20 lakh. Now, if the grocery can reach your place in 10 minutes, why can't an ambulance reach your place in 10 minutes? गोल्डन आवर का कॉन्सेप्ट हम सबको पता है. द फास्टर, आज मेरे और आप जैसे लोग शायद एक्सीडेंट देखेंगे तो शायद कहेंगे यार कौन पचड़े में पड़ेगा. Once in a while, I called up somebody, I saw an accident, I called up the cops and said कि यार यहाँ एक्सीडेंट हुआ है. For next 7 days, I was literally like, आप वहाँ से गए कैसे? अरे भाई मैंने तो रिपोर्ट की है. नहीं आपको वहीं खड़ा होना चाहिए था जब तक पुलिस नहीं आती. आप गए कैसे? अब आप यहाँ आओ, अब वहाँ आओ, etc. Like why can't I just open the Park Plus app and say report there is an accident with a photo, and then ambulance comes it immediately? Like what's a big deal? It's a car owner. So hospital will also make money. Insurance company will also make money. There is just no reason for these customers to be not serviced. So far we have raised close to about $50 million. I think half of that money is still in the bank. So from beginning itself we have been very, very careful around, very, very frugal around where to spend money, how to spend money, but still deliver a fairly amazing consumer experience.
Thank you, Amit. We'll again come back to the role of customer experience journey in the path to profitability. A quick reminder, if you have a question, Eric is standing there and collecting. Just raise your hand, he will come to you and collect the questions. Maybe, Sanjeev, we can go to your journey.
Yeah.
While they're still on their way to profitability. Show us a little more hope.
So they are making profit. I think it's a very, very interesting stories. Since morning I've been hearing, and it's a awesome story. So I think one of the probably the difference that I can probably share from my journey is not only the company making profit, but how do the founders make profit. So that is one of the important elements of starting the business, that eventually why you are into that business. A few reasons. One is obviously about the passion and building something large, but at the end of the day there is also some commercial element involved into all these things that we create, because we keep on talking about the wealth creation and all those things. So unless you make a profitable exit, I think the short answer is that as founders it's very unlikely that you will end up making money. You are the first man in and you are the last one out, literally, in terms of making the money. So you will have the investors, you will have the employees, you will have a lot of people going in and going out of your ship, but you are literally the captain of that ship, and you have to stand there till everybody has safely exited out of that. So that I think is a big journey. So you can also relate it to the story of say Abhimanyu. मतलब एज ए फाउंडर और एज ए स्टार्टअप थिंग यू कैन से कि भाई अभिमन्यु की तरह हम चक्रव्यूह में घुस तो जाएंगे, पर उसे बाहर कैसे निकलेंगे, दैट इज लाइक वन ऑफ द बिग questions, or at least strategically one should be thinking about that. How are we really going to make that journey smooth while going in and smoother while going out or coming out of the whole thing? And this pretty much gets reflected in my first startup, which was Amplus Solar. And I started in 2010, got first funding in 2015, exited in 2019. So it's like I would say it's like the initial part, and I will borrow one of your phrases about the valley of death or the valley of sorrows, like almost like 2013, when I decided like, as enough is enough. This is not probably, I'm not made out for this, and I want to draw my insurance check, as Deep was mentioning in the morning, and saying go back to a job and probably do something more useful. It's like how long you can really be hanging around and saying this is not working and you want to still do it. But I think every day when you come back, and this again comes back to the point about who are the people that are working with you and how many people you are responsible for. Because you have people who have come on the dreams that you have shown them. You have people where you have promised a lot of things, and they all believe in your vision. And you don't want to, you think like, okay, let's give it some more time, and suddenly you will start coming yourself out of that valley and saying like, now I am seeing really the bright stars out of the whole thing, and then one day things change. So it again boils down to one of the often repeated points about the perseverance. So which I also call about like the consistency part of it. How consistent you are in terms of your effort. Are you making some difference every day? Are you really coming out with some solution which works for your customers, which keeps your customers delighted? And I like Amit's point, and it's a awesome journey. I stay in Gurgaon, and everywhere I see, every locality will find a new barrier come up. I said, who passes through this barrier, by the way? And there's a guard also standing there now. And so they are creating something which is unique and useful for the customer. So can you think of more and more areas where you're creating the profitability? It may not be like the real money, but it's a perceived benefit for the customer. So when you're talking of the profit, you're not talking only about the profit for yourself. You have to look at the entire ecosystem that you're serving, whether it is your customer, your employees, your shareholders, yourself. Is each of these persons making profit? If each of these people are making profit, your company will make profit. And your company is making profit, you will make profit. So that's the type of ecosystem that you have to see from a consistent point of view, that how do you keep on building and adding on to things. And then you take the action on the basis of that. And action means that we talk about the A/B testing and all those things, that you keep on coming out with the solutions without trying to perfect it. And there's always a dispute about, I'm trying to perfect my product, I will take it to the market, I will launch at the right time, but there's no right time. You have to be sitting in front of the customer. आपको customer के सामने बैठना पड़ेगा. Rooftop projects जब हमने start करे थे 2013-14 के अंदर, like literally there were no takers for the rooftops, including IIM Ahmedabad. I in fact offered to IIM Ahmedabad कि हम यहाँ free में लगा देते हैं. मैंने कहा branding मिल जाएगी इतनी तो, अगर यहाँ पे लगा देते तो भी उसके अंदर जो bureaucratic process है, उसके अंदर you will spend like 6 months, 12 months, but there will be no decision. I don't know if still there is a rooftop solar plant on this building or not.
Quite a few.
Now, there were always like this solar water heater, but I'm talking of the electric plants. Electric plants are great. So somebody has been able to crack that equation.
Mostly the new buildings.
Yeah, correct. So it's a difficult conversion, but you have to be consistently taking action and going to your customer saying ki like, what do you really need? What will convince you? Because you're also giving a solution. We said we will invest the capital, and you just have to pay for the electricity at a price lower than what you are paying to the grid. That okay, what is the catch? ऐसे कैसे कि आप पैसे भी लगा रहे हो, maintain भी कर रहे हो, पैसे भी कम ले रहे हो. How is it even possible? So those were the times. But you have to keep on coming out with the new solutions, going to the people and saying like how this is really going to work. And I think the last point, which is very important from a trust building perspective, or the profit perspective, is the trust. How much trust you can really imbibe in the minds of your customers, in the minds of people that work with you, in the minds of your shareholders. And this is, I would say, the most important point about building the credibility as an organization, building the credibility as a leader, building the credibility as a solution provider to your customer. That is where people really come back to you and say, like, if I come to them, I am definitely going to get a solution. And they will deliver whatever they are saying. So I think these are some of the points if you keep focus. And I call this business building as a multi-axle vehicle. It's like we have like probably 4 or 5 axles of the whole machine. And if one of them is moving fast or slow, you are bound to fail. If your revenues are moving faster than your cost, or your people are not able to keep pace, or your things are not happening, processes are not able to keep pace, your machine will break down. So can you keep this whole balance without taking your eyes off the ball? That is what will create a balanced delivery and a balanced vehicle, and that's what will eventually take you into that profit zone. And that is what I would think is the right solution. So if you, in terms of if one has to take these 3 things, is probably I would put in the language that all of us have gone through, the CAT, the consistency, action, and the trust. So be consistent, take action consistently based on what is the feedback you are getting, and create the trust. So if you, all of us have cleared the CAT here, so follow the CAT and you'll be the tiger. Thank you.
Thank you. Maybe you can still hold this.
Sure.
So I'll maybe take this question and also combine it with an additional question to you. given that you've seen the whole journey and you said it is about going in. Usually when you go in, it is investors giving money,
Yeah.
create value. Mostly it is wooing the customers. And then when it is time to come out of the chakra view, as you rightly said, oftentimes it is the not so hard banks coming out quicker than the founders, right? Sometimes even all sorts of games get played. So how do you how do you ensure the good governance?
Yeah.
Because, for example, I often cite this in the classroom that it also requires and then especially when we are in our curriculum, when we teach strategy, when we teach governance, ethics, many a times those are and we have seen very recently lots of examples around that. So while you are managing your journey on this growth curve, going in with everyone and then coming out and somebody is blindsided you and went out. So how do you make sure that you as an entrepreneur also cash out, book profits, make sure that the business after you is sustainable, and do all of this in a not just legal manner but also an ethical
No, absolutely. I think the trust is the most important element in the whole thing. Probably it's not, it's underrated, the corporate governance part of it. How do you keep your whole business extremely transparent? So don't try to hide anything from your investors. There will be bad news. There will be days when you're not able to do the way you thought it will happen. And there is a pressure on you because, and this was in the earlier session than this one, that there is a pressure of valuation. Because you said my revenue is $100 million. And suddenly you realize this year is going to be $70 million. I'm going to make losses. Do you inflate it to show that it's 110? Are you doing a circular trading of the whole thing, or are you being transparent enough, honest enough, saying कि नहीं ये भाई 70 ही है, मैं इसमें कुछ कर नहीं सकता हूँ, but we'll do whatever we have to do to make sure that this is, we'll try to fix it to the best of our abilities. I think that's a single most element today, because the capital that we are getting in this country, as the earlier VC panel was saying, is largely coming from US. And 90% that capital is coming from the international investors. International investors put the highest regard on your ethics, compliance, and the transparency part of it. If you're not doing that, whatever business you're doing is not worth it. Honestly, it's not worth it. Right? So therefore, keep that professional integrity at the highest level. Everything else is second.
Maybe I could go then next to Amit here. So you were you found a blue ocean in this parking slots business. I think you also started more like a valet to begin with. You were having problems finding the slots, and then you realized that parking itself is a issue to be solved. You're a first mover, and then comes the second mover. That's exactly the question. If there is more competition, and that's burning cash as well, because now they've seen and they've gotten money, leading to depressed gross margins across the industry, then how do you focus on profitability, the exact things that you said, while knowing that now the game is going to shift on growth rather than profitability? So how do you manage that trade-offs, or rather, as Sandeep said, do you then activate the plan B of growth at all costs, or would you rather stick to your no customer acquisition cost?
So I think first,
I don't know whether you are still in this spot or not, but
okay. So first I'll talk about the blue ocean thing, and this is something what I learned at IMA. I think the biggest learning from my IMA thing is, like it was like you had so many smart people around, and you were like कि भाई ऐसी जगह जाना ही नहीं है जहाँ पे smart लोग हैं, ऐसे market में जाना ही नहीं है where there are like enough smart people there. You can't compete with these guys because everybody of them would be believing in their abilities to raise capital, discount randomly, etc., etc. And it is always going to be a red ocean. So don't even go in those segments which are going to be very, very highly competitive. So that's the first thing. So for example, if you see my career journey, I haven't been into e-commerce and all those kind of things which were hot earlier. From campus, I went to online travel. That time, nobody was going in the online industry. Then I went into payments when everybody was going into the Flipkarts and Amazons of the world. Then I went to Indonesia, not to the Ubers and Olas, and now this thing. So first of all, going into a sector where there is less competition, less talented people around, etc., hard problems, gives you a lot of time to understand that sector. You don't have to jump on day one and then try to, मतलब हमें लगता है कि यार मुझे तो प्रॉब्लम समझ आ गई, अब लोगों को मैं सॉल्व करता हूँ. मतलब अगर इतनी ईजी होती समझनी और सॉल्व करनी तो कोई ना कोई कर चुका होता अब तक. तो इट इज़ नॉट वेरी ईजी. द सेकेंड थिंग आई थिंक विच इज़ मोर इम्पॉर्टेंट ऑल्सो, वंस यू गेट इन, you would just not allow anybody else to get in. आपका प्रोडक्ट क्वालिटी, आपकी डिलीवरी, आपका कस्टमर ऑब्सेशन, मतलब यू टेल द अदर गाय, भाई इससे लड़ने में एनर्जी लगानी है या कुछ और कर लो, कुछ और करना बेटर है. सो यू जस्ट मेक श्योर दैट द एंड you do not have regulatory advantages, etc., which a lot of incumbents would have. But what is the advantage that you have is the kind of flows that you build, kind of journeys you build to just make it super hard for anybody else to get in. Like to give you an example, our access control business, boom barriers, you would have seen it at a lot of places. Now 7,000 plus locations across India. You mentioned every third society of Gurgaon uses Park Plus. That is on rent. We don't do capex. Which means if it doesn't work, I don't get paid. But which also means if tomorrow somebody else have to compete with me, he'll have to also give it on rent. And if it doesn't work, he'll not get paid at all. So my system will work, his system will not work. Chalega hi nahi. I perfected the journey during the COVID times when from a society only 100 cars were going out. Today it is full-fledged, 1,000 cars are going out. Nobody can perfect the journey now. So continuously build those journeys very, very proactively, very aggressively, and you build a stitched kind of a journey. When you build that stitched kind of a journey where, like, for example, parking cinema halls. Now we are live on Book My Show. When you book a movie ticket, you can book a parking also. So if tomorrow somebody else goes to the mall guy and say, can I manage your parking? The cinema guy in the mall will say, nahi, Park Plus nahi hat sakta because Book My Show se log book karte hain. So you just keep building those
switching costs.
Yeah, you just keep building those integrated deep loops, which just make sure that it becomes harder and harder for anybody to get in. And one other philosophy which I've been very clear that want to be the expensive guy in the market. To 25% of the customers, I want to tell them, sorry, you can't afford me, it's okay. And when you tell a car owner, sorry, you can't afford me, but your neighbor can afford me.
FOMO.
वो literally वो है कि मैं कैसे afford नहीं कर सकता, मैं भी देता हूँ. See, if you look at like last 1.5 years, मतलब 3 साल 4 साल पहले आप गाड़ी खरीदते थे तो you'll say discount. Today dealers have figured out and OEMs have figured out. Say there is a waiting period. गाड़ी खड़ी है but बोलेंगे there is a waiting period. So the customer is saying यार मेरे से 1 लाख रुपए फालतू ले ले, 2 लाख रुपए फालतू ले ले, 5 लाख रुपए फालतू ले ले, पर गाड़ी आज दे. ठीक है सर, लाओ 5 लाख फालतू लो गाड़ी. So building those journeys where customers will say यार मेरे को यही सर्विस चाहिए, यही ब्रांड चाहिए, मुझे ये लेवल ऑफ एक्सपीरियंस चाहिए. मतलब 2 years down the line our TV ad would say क्या आप अभी पेट्रोल पंप जाते हैं पेट्रोल भरवाने? क्या बात कर रहे हो, कोई भी नहीं जाता. तो then everybody says yeah, I want to also have that experience. Like when I launched Paytm with Uber, that time like you just are talking on the phone in the cab and you just get out. Nobody stops you. In fact मेरे साथ 3-4 बार यहाँ हुआ जहाँ कैब वाला मेरे पीछे आया, भैया आपने पेमेंट नहीं करी है, and then I realized I was not in Uber. मतलब वो उबर की आदत इतनी हो गई. So build those flows where everybody loves you. Like we were talking about in the last session, talking about first mile sales guys or the delivery boys. See, we do valet, we do drivers, we do car cleaning. Our guys get paid every 7th day. Money goes in their wallet, they can take out. So if you are a driver, if you go to owner directly, he'll pay you on 30th day. And that too also when you ask for payments for a couple of times. But with Park Plus, every day the money gets credited in your wallet, every 7th day you can take it out. So even if the customer tells the driver कि भाई मेरे से सीधा काम कर ले, वो कहेगा नहीं करना मेरे को, हाँ यहाँ से 7वें दिन पेमेंट आती है, आपसे 30वें दिन आएगी.
Just out of curiosity, you have the washing folks or you take it from urban company? Or?
No. So we have built that whole mechanism gig thing. So every car wash you get paid kind of a thing. So again, system driven, it is very hard to build. Like building everything on, like one other things which I learned about the front end guys is, are you paying their salaries on time? Transparent and on time. Most of the companies struggle because अच्छा 7 को नहीं आएगी, 9 को आ जाएगी, 9 की जगह 10 को आ जाएगी, अच्छा 500 रुपए इसके कट गए, 200 रुपए इसके कट गए. Those people are so sensitive about the exact amount and exact date. If you pay them on time, if you pay them properly, even if there is a penalty, if they know I got penalized $500 for this, they are okay. The problem is nobody knows. Like if you talk to most of the Ola drivers, most of the Uber drivers, they will tell you,
cash.
पता ही नहीं. मतलब why do they want cash? Because they don't know कि यार कब आएगा पैसा, कितना कट के आएगा, किस चीज़ की पेनल्टी है, कितना कमीशन है. Because there is one fee here, there is second fee here, there is third fee here, there is a fourth fee here. Like if you look at Zomato now, Zomato guys are investors in Park Plus, so, but like there is a delivery fee, there is a convenience fee, there is a platform handling fee. Like आप ऐड ही करते ही जाओ. आज आपकी मोनोपोली है, आज आप कर लोगे. Someday.
Yeah, and I think that the same thing goes back to having more ethics, more transparency. In fact, I think Urban Club has been doing this, that they publish all the transparency, and in fact, Professor Mukherjee is there, Saral Mukherjee and I were discussing. They're like the Indian placement reporting standards. They brought in a lot of transparency among that, and by the way, challenged others to start doing this. So ultimately, making money for yourself will also require to make sure that everybody is kind of making money and not just one of the stakeholders, which is the investors. Let's move to Sandeep. There is a direct question for you, which goes back to your 3 stages. And when you said that growth at any cost, and then suddenly you had to have a balanced growth, what kind of risk do you run when you are growing fast and then suddenly you have to put the brakes on? So what kind of risk? You must have done some risk analysis at that point. And the question is asking what kind of risk on increasing cost, also on getting into the phase 2, what all risks were you aware of that you were getting for growing into at any cost when you went back to do the Excel work? And then what are the kind of controls as an entrepreneur did you focus on to bring back the control on the car? So the acceleration and the brakes. And do you have some kind of tips on where should you look at those?
Sure. I think the most important thing is the culture of the organization. Like as you are going from the 3 phases, as you're transitioning from 1 to 2 or 2 to 3, your culture is what makes or breaks the organization. I think Amit put it very well, and then Sanjeev as well in this, that the organization, we talked about the ethics and everything else, but just think of it this perspective, right? When you are growing at all cost, then pretty much anything that is a cost but is in the direction that can give you an incremental, a basis, 1 basis point, 2 basis point of growth, you will just do it. And no questions asked kind of a stuff, versus in a scenario where it is that, okay, you know what, we can sacrifice some of the growth, but we need to get into a profitability kind of a situation where then you start questioning every person which is in the organization in terms of, have they met their OKRs, have they met their goals, is this person really adding value to what the outcome is? And if you have to end up taking a hard decision over there in terms of the person not remaining in the company, let us say, then with their exit, what is the cultural kind of gap that gets created? So I think the biggest thing is the culture of the organization. And as the founder, if your culture is very, very strong and you are deeply entrenched with your entire staff and your team and everything else, then moving from one phase to the other or going back a gear here or there becomes very, very easy. So it's pretty much your team and the culture that defines as to how quickly, fast you can go back and forth. And then obviously it's a little bit of a nuanced answer in terms of every sector, every market as to what and how it will happen. In our case, as we were going from 2 to 3, what really helped was that if, let's say, the Googles and the Amazon and the Meta, everyone is like taking that decision, they're still doing it. So we got a lot of air cover as we were taking that decisions. We still got into the public media and everything else in the US, लेकिन तब भी काफी कम level पे हुआ. Otherwise, if you are just doing it without the market defined or market determined kind of like, तब आपके ऊपर ज़्यादा हल्ला मच सकता है. My point being, so culture internal and then external, you have to obviously look at what the market is, where it is happening, and then accordingly you align.
Thank you, Sandeep. I think I have been already signaled by the organizers, you were right. that the profit panel has to be cut now because there will be very less amount of sunlight available for some of us to fly some kites. But I think what if I can actually summarize all three of you, there was the trust in the employees, trust in the team, customer flow. All of that tells me what we have always learned at IIM Ahmedabad and all of us here who have been in the classrooms, that one will have to go by the first principles. Ultimately, it is going to be, using our word in the afternoon, the danda, which is going to be, as long as the employees, customers are happy, ultimately the founders and the shareholders are also going to be. But it's going to be a tough journey, and I hope all of us see through this entire journey. And thank you all for sharing these insights, although it was a very quick panel. Over to you, Ashna. Thank you very much.
Thank you so much. We'll just request all of you to get together for a picture. Perfect. Thank you so much to the audience as well. I now invite Mr. Anurag Chaudhary, who is the Associate VP of Alumni and External Relations at IIM Ahmedabad, to please give the closing remarks.
So thank you, and I want to make sure that I don't miss out on anybody. I thank everybody. So we've had a really spectacular session today since the morning, and we've had a great set of people, amazing ideas, amazing insights, and I'm sure you'll all agree with me that we've had a power-packed day today, and with amazing people, ideas, and insights, right? At the very outset, I want to thank our director, Professor Bharat Bhaskar, and Dean AER, Professor Sunil Maheshwari, for their constant guidance, inspiration, and encouragement to think big and work towards truly ambitious goals, and continue to contribute to developing the entre ecosystem in the country, right? So thank you, sirs. I want to thank Mr. Madan Mohanka for sharing a bit about the challenges, the trials and tribulations behind all the amazing successes that he has had as part of his fantastic entrepreneurial journey. Right? Many of which, of course, came at a time when things were many orders of magnitude more difficult than what we can imagine today. Right? And those were completely different times, the completely different structural elements. With the license Raj and all the other kind of constraints that were there around that time, right? And so because of that, he's also a inspiration to many generations of entrepreneurs to come, right? And so I'm very thankful that he could be with us today, and extend my appreciation to him. I'm grateful to our outstanding speakers and panelists for being so generous with their expertise and insights, and sharing it with the audience. Each one of them is an inspiration, and through their achievement also is a source of strength and knowledge and guidance to many. Right? I'm sure the insights and perspectives that they have shared will inform and inspire quite a few initiatives and successes down the line. Right? I'm also thankful to all the faculty, including previous chairpersons and current chairperson, and whose guidance, handholding, and support has shown the path and allowed CII, now IMA Ventures, to grow and develop into what it is today. Right? I'm also thankful to the Chief Administrative Officer, Colonel Amit Verma, for his guidance and support. I want to thank all the startups and investors and all alumni who could join us today for coming over to be with us and being a part of this journey. And I hope that you also find it as enriching as we did. All of this, of course, wouldn't have been possible without the tireless efforts of all the members of the core committee, a core team of the Entre Summit, the IMA Ventures team, the Alumni and External Relations team, communications team, students and staff of IMA, the PGP and PGPX on 3VC clubs, the sports committee, Decibel, StringX, students and alumni external relations cell, who helped and who came together to put all of this together, right? To all those who joined us for these sessions, thank you for coming and being so kind and patient with us. And I hope it was an enriching experience for you. In celebration of Makar Sankranti, we've organized a small kite flying festival in the Iima Ventures lawn with some refreshments. So I hope we see some of you over there as well. So big thank you for each one of you. Now I would like to invite the Iima Ventures team to come over on stage for a picture, right? And just to have a celebration.
I want 1 minute of your attention. All those people who are there on the stage, they have worked very, very hard to materialize this, curate each and every session so that every panel discussion has a unique learning experience. A very big round of applause for the entire Iima Ventures team. Great, thank you. Thank you, all of you. Thank you. सब अपनी फोटो का खुद जिम्मेदारी लो।
Yes. Everybody say, Iima Ventures.
Thank you. Thank you. Well